of a seeming lack of attention to detail, a few flubs here and there in the way that, frankly, the company is run. It doesn't really seem like that is happening, at least not yet. There is a new leadership, relatively new leadership team at Lyft. I think the thing that's one reason why the reaction was so outsized initially is like, this is a big year for Lyft. It could be the first year in which they post a profit at least on an operating basis, if not quite on a net basis. So the fact that it looked as though they might massively outperform expectations was huge. They have, as we know, colossal competition with Uber. Uber has different revenue streams. It has international revenue streams as well. It is very much the 500-pound gorilla in the room, whereas Lyft is a little bit more, well, you could say it's more agile, but it struggles to compete financially with Uber. So that's why an attention to detail is super important, because it's working on way finer margins than Uber does. At the moment, we don't have evidence that there is more than this kind of error, but it puts management under a lot of pressure to ensure that such mistakes don't occur.
Alex, I have to say, just even the idea of a clerical error makes me think of someone in the back room with little cue cards trying to file them. It sort of harkens back to another era. Just moving on, though, there is this point that the earnings were strong, that they really did show growth in earnings, and people are using ride-sharing services at a pretty significant clip. Is this a broader statement on consumer appetite, consumer ability to keep spending? Because it's not just Lyft, it's also Uber. It's not a market share thing. This is just an all-in spending thing.
Yeah, and it was interesting that they attributed some of the gains to big touring events, Beyonce, Taylor Swift. The fact that people are going out to live entertainment, there was some questioning whether that boom that we saw immediately after the COVID pandemic was starting to taper a little bit. But according to the statements from Lyft yesterday, it doesn't really look like that's happening. They're really getting that tailwind of people going out and trying to enjoy life, which is good news across the board for when you think about any industry that's dependent upon consumer sentiment. So yes, they are clearly benefiting from that. At the same time, the fact that a few big live touring events can affect their their earnings to the extent that they're willing to talk about it shows actually that maybe they are dependent on a few small wins in either direction in order to keep on the trajectory they want to.
Alex, thank you, sir. Alex Webb there of Bloomberg, just slowly moving past the so-called clerical error and looking at the move this morning off the back of fairly decent earnings. We're higher by 21% in the pre-market.
Evidently, Taylor Swift is to blame or to thank. Yeah, she evidently runs the world, and she's the reason why ride-sharing services are, seeing the ridership.
Every single conversation. I didn't realize that Uber was up by close to 100% over the last year.
The earnings have been incredible, and this really isn't, we were talking about during the pandemic, how long are people going to spend $30 to get their $12 salad, right? I mean, there's sort of this question of how much people can actually spend on this stuff, and it turns out they can keep spending. I mean, this to me highlights the abilities of consumers to spend. Maybe it's that they want to spend because Taylor Swift and Beyonce, but I think that there are other things too that just speak to an incredible amount of cash that just hasn't run out.
Do you want to talk about that salad that rhymes with sweet and green? Do you want to talk about that? You notice that it's got maybe less in it than it used to have.
Are you saying shrinkflation?
I'm just saying that maybe shrinkflation might be a thing about a salad place that rhymes with sweet and green.
Yeah, especially if you get the protein and it's like cut in half.
You ask for chicken and it's just like,
it's one strand.
Couple of strands of something,
Yes.
they sort of get the carcass and they spray off what meat's on it. That's what it feels like when you go to some of those places. They just sort of throw some protein.
Talk about, I'm sorry.
I know it's early. If you're enjoying your breakfast, I'm sorry. But that's what, sort of some of those salads feels like.
I hear you. I mean, this has been going on for a while. And it's, at what point are people willing to pay to get more chicken?
Maybe the president is onto something, Gramo. Maybe he's onto something.
Is. We've been talking about shrinkflation for a long time, but
maybe
this
longer.
has been forever. Exactly. I mean, you get, instead of 8 ounces, you get 6 ounces.
Yeah,
I mean, how long
and
have we
you pay the same, if not more.
Of course, but this is, maybe some people say this is sort of the treatment.
It's great. It's what happens when a company goes public, It's not. Maybe it is. Equities right now on the S&P 500, positive here by 1/3 of 1%. Let's get an update on stories elsewhere this morning. Here's your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. House Republicans voted by the narrowest possible margin to impeach Homeland Security Secretary Alejandro Mayorkas. An attempt last week to impeach the secretary failed after a deadlock. One lawmaker returned from cancer treatment to reverse the embarrassing defeat. Mayorkas becomes the second cabinet member in U.S. history to be impeached. The effort is likely to die in the Senate, where a 2/3 majority is needed to remove him from office. Shares in Airbnb are lower in the early trade. The company reported strong fourth quarter results on continued post-pandemic travel demand. But Airbnb expects the number of nights and experiences booked to moderate this quarter as demand normalizes. Jeff Bezos has sold another $2 billion of Amazon shares after he sold $2 billion last week. Regulatory filings show the sale of 24 million shares took place just over 4 trading days. The world's second richest man has said he plans to dispose as many as 50 million shares in the company he founded. Amazon is up 11% so far this year. That's your Bloomberg Brief, John.
Hey, Danny, thank you. Appreciate it. It's either incredible market timing or the most phenomenal midlife crisis in human history. Just absolutely amazing. Can you imagine having that kind of access to that much money?
So there is a theory.
What's the theory?
It's taxes.
Yeah, of course. Capital gains tax
Over in Florida?
Washington State.
Yeah, that basically he left Washington State in November and goes to Florida, and I think he saved something like, let's see,
7% tax on $250,000 or more in capital gains in Washington State. You get none of that in the Sunshine State of Florida.
And that means that he probably saved $288 million so far because of that move in taxes that he didn't have to pay.
That's awesome. Isn't that incredible? The amount of money you can save by making that move.
Are you planning on moving to Florida?
I don't have that much cash, Bramo, to make that kind of trade.
You're gonna cash out of your surveillance shares?
If I did, without a doubt, I'd buy the boat, I'd go sailing, I'd do the whole thing.
The lemon groves?
Yeah, absolutely.
Yeah,
the Amalfi Coast, all of it, just everything.
We'll work on that.
We'll try. Up next on this program, U.S. inflation running hot.
The strength of this economy has befuddled economists. I think the Fed's made the right choice. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left in that gun.
That conversation coming up next, live from New York City. This is Bloomberg.
I'm relieved that, at the very least, the situation between China and the U.S. is calming down, and at this stage, we just don't need something else coming, for sure.
Are you confident, actually, that the U.S.-China relationship will get better?
No, I'm not confident because I'm not in control of that. But what I know is that the world cannot afford an escalation, and most likely both countries cannot really afford some things to escalate in terms of economic consequences. I mean, the situation in both countries is fragile, and you know, I guess a geopolitical escalation is not going to be in the interest of both countries.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Equities on the S&P 500 positive here, a third of 1%. We're down about 2 basis points on the 10-year, 429, down just a little more than 2 basis points on the session. Under surveillance this morning, U.S. inflation running hot.
The strength of this economy has befuddled economists and all your guests for the decade. And if you look at where all the dot plots have been, even those folks who have all the information have missed this. You are seeing some signs of a hardening of economic conditions that are finally coming up. I think the Fed's made the right choice. They put themselves in a really interesting position right now where they can mute volatility with having a lot of bullets left.
Here's the latest this morning. Traders pushing back Fed rate cut bets from June to July after yesterday's hot CPI print. Sarah Wolf and the team at Morgan Stanley forecasting a rising core PCE after the latest data, writing this: "We think the sequential prints in the first quarter will be overall higher than what we've seen in the last 6 months. This acceleration will be one factor delaying the decision to start cutting rates to June of this year." Sarah Wolf joins us now to get into some of that data. Sarah, can we just compare and contrast what goes into CPI and what goes into PCE, and just how wide is that spread right now, just in terms of where those two numbers are?
PCE is everything that you spend and then everything that gets paid on behalf of you. So think about health insurance, for example. Your employer pays for that on behalf of you, so that'd be captured in PCE and not CPI. There's also different weighting. So PCE, the weighting evolves each month when consumers shift their spending preferences. And so typically CPI and PCE run very closely, but right now we're seeing a pretty large wedge between the two measures. And right now CPI has been running quite a bit above PCE. Our implications for PCE right now, based on CPI, it's actually for 0.3 core PCE this month compared to a 0.4 on core CPI. So it's looking a little bit better. And one of the key things is that core services looks like it's going to be a little bit softer in the PCE print than the very hot core services that we saw in CPI.
You know, normally you would expect some kind of commentary from Fed officials. This is just one print. Ian Lingen over at BMO Capital Markets said typically one would look to the Fed to deliver assurances that a single data point doesn't make a trend, but we're skeptical of that approach given current conditions. He talked about how trying to explain away the strength in CPI is going to be tough because of the broad-based nature of price increases. Do you agree with that, Sarah?
It definitely was a very broad-based increase this past month. If you look at the breadth of acceleration in the CPI print, it was fairly wide. If you look, for example, you could look at the Cleveland Fed trimmed mean measure, and that showed a pretty notable acceleration. So it's definitely worth watching, but we do have to remember it is one data print. We saw 3+ months of soft CPI and PCE prints. It gave us a lot of confidence that inflation was on the right trajectory. This is exactly why the Fed said that they wanted to see a few more pieces of inflation to believe that inflation was sustainably moving towards 2%. And it's exactly for this reason, because you could get some outliers like this where CPI reaccelerates. Right now, I believe that they're going to say it is one data print, but they're going to keep watching. So it doesn't change the Fed's trajectory. But if anything, it does keep June firmly on the table, where it's just enough time to get a few more prints and feel confident that this is just a one-off. It's not a break in the data. We do get 3 more CPI prints ahead of the next Fed meeting, then a 4th on the day of the next Fed meeting in June. And then we also get 4 more job reports, actually. So there's quite a bit more data to come before you get to that June FOMC meeting this summer.
Sarah, you sound a lot more sanguine than a lot of the analysts that I was reading reports from, who are all saying this actually is significant and this is kind of a game changer when it comes to just the broadening out. You can't just explain this by seasonals. Do you agree? Do you think that there's like a messiness underneath some of this data that makes it dismissible as sort of a blip?
There's definitely some issues with the seasonal factors. The government agencies are trying to get it right, but we know there's a lot of noise there and maybe a bit of a bad signal that could be coming from some of the seasonal factors. But we also know that some of these components are on the right trajectory. Shelter, for example, that reaccelerated in the latest print, but all of the forward-looking indicators on, the new tenants index, for example, is showing to a much cooler path for shelter inflation in the back half of the year. So even though we got this jump right now, I think we could feel confident that the forward-looking data is still looking fairly solid for shelter, which is about 1/3 of the overall basket. Then you look at the other core services, and that's very tied to wages in the labor market. I think that's where we're a little bit more concerned. We've been seeing progress in wages for about a year now, but now with this reacceleration in payrolls, it definitely calls into question, can we feel confident that core services ex housing is going to remain on the right trajectory? And I think that's yet to be seen. It's hard to know if this reacceleration in payrolls the last few months is here to stay, or if it's a little bit of a one-off and we're going to see some reversion in the February and March data. So it bears watching, but it's too early to pull it out as this is where the future of inflation.
Richmond Fed President Thomas Barkin recently talked about some of these companies that had to raise some of their prices. He says is it conceivable now that's off the table? Will they continue to do this? When you look at some of these basic food prices, for instance, going up, will they have to maintain these elevated prices to maintain a profit?
It's going to be tricky for them because we know that consumers are also becoming a bit more price sensitive, in particular at the lower middle income distribution. And so even though, labor costs are high, so it forces them to push some of that pricing through, we know that it's becoming increasingly difficult because of a household that is pulling back a little bit on their spending. We know lending standards are tightening, access to credit is getting more difficult. And so there's less of that willingness to take price among households, and that's going to be pushing back against households, against businesses and their ability to pass through price.
Sarah, let's finish by talking about the weather and retail sales. Can we do that just briefly? When payrolls came out, just before it, people told me that it was warm, so payrolls are going to be good, and now I'm being told it was cold and retail sales won't be great. How is there a difference between the two? Is it a survey week? What was it?
It looks like there is a bit of a survey week problem. The first half of January, that's mostly captured in the payroll report, was a bit warmer. The back half was a bit colder. Retail sales will capture the entire month. So it'll capture the warm weeks and then the cold weeks. What we're actually looking for in retail sales is a negative 0.5% on the month. Part of it is weather, but most of it is seasonal factors. And not to get a little nerdy here, but historically the seasonal factors look for massive holiday spending in November and December, and then a big drop off in January. The seasonal factors have been a little messed up for retail sales the last few months because of abnormal holiday spending patterns. And we think that it's not going to be adding enough back into retail sales in January, given how strong November and December sales were and the big decline we're expecting for January. And so be looking for that, the unfriendly seasonal factors for Thursday, retail sales, and it's going to result in a negative print. We think that could take some of that pricing also back from July into June, showing a little bit more deceleration in consumer spending, and also showing that maybe some of that strength that we saw in November, December retail sales was actually the bad seasonal factors working in the other direction as well.
Interesting. Appreciate the clarity. Sarah, thank you. It's good to see you. Sarah Wolf there of Morgan Stanley. Going into retail sales tomorrow, Lisa, they're looking for a negative number. The street is as well. The survey here at Bloomberg, the median estimate, negative 0.2%.
Yeah, if you strip out some of the seasonalities, though, the control group is expected to have 0.2% of an increase. Honestly, if you get a hotter than expected print for retail sales, what does that do to market action?
Yeah, that starts to get you talking about overheating even more, right?
That, I think, would really build on maybe not a narrative shift, but maybe just a little gut punch.
Just sort of leaning
just sort
further to the other direction.
Yeah.
You love this Goldilocks taking a punch thing.
I do
Remember when I told you about kids tuning in accidentally, turning off the cartoons and tuning into business news?
And they're getting very
Ramo's
disappointed.
talking about fairy tale characters getting smacked around.
It's the new, I don't know, it's the
by
new
economic
cartoons.
data.
No, it's pretty wild. It's pretty exciting.
Coming up in the next hour, more excitement. Tracy McMillan of Wells Fargo, Michael Shepard of Bloomberg News, Pierre Farragut of New Street Research, and Colin Martin of Charles Schwab. From New York City, equity futures on the S&P 500 positive by 0.4%. Live from New York, this is Bloomberg.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The depth and breadth has surprised economists and guests across the board, and it's a much more resilient economy.
The consumer hangover eventually will come, but we're not seeing any signs of it yet.
When you look at the health of the market, I think you still have to argue it's pretty broad.
The ability for equities to go considerably higher as earnings become clear is what we have to focus on.
For the equity markets, the important thing is this soft landing is continuing.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg alongside Lisa Abramowitz together with Anne-Marie Hordern. I'm Jonathan Farrow. Your equity market is bouncing back on the S&P 500 by 0.5%. Plenty of laughs and jokes about Lyft's move overnight, just a ridiculous move off the back of numbers that weren't real. 500 basis point guidance for margin expansion this year turns out to be just 50. That stock fades, still positive by almost 20%. And good news for Uber shareholders. Lisa, this one just dropped in moments ago, announcing a $7 billion share buyback.
Which really builds on all of the buybacks and dividends that we've been hearing from a lot of companies. I have to say, it feels like there's a new emphasis on that with near record pace of some of these being announced. They talk about an inaugural $7 billion share repurchase authorization. And this comes as Instacart laid off a whole host of people and authorized share buybacks and dividends. So there seems to be a new focus on distributing capital in an era where people want income from those shares because guess what? They're getting a lot of money and the owners want to get some piece of that.
And they've got the money to do it. We're talking about buybacks at Uber, first one. We're talking about dividend at Meta, first one. These are big changes.
Especially at a time where there's a new emphasis on exactly how profitable someone is and what the growth potential is. And guess what? These companies are meeting it. And that, to me, is a shocking thing at a time we were supposed to be talking about decelerating growth.
Well, we're going to talk about hot inflation right now. The takeaway on the south side. Lisa's gone through some notes already this morning. Citi, service inflation is sticky. Bank of America calling it a detour from disinflation. It is nightmare on Biden Street. AMH, that print yesterday.
Yeah, it is. What you're going to see from the White House is they're going to say, remember where we were and look how much far we've come. But Treasury Secretary Janet Yellen said she was loath to talk about any one variability in one inflation report. But the issue is when you look at what's going up, it's issues that you cannot escape. Every day, Americans are reminded that grocery prices, whether you're dining home or eating out, are going up. The only gem in this print report was that gasoline prices decreased so much. And there's also obviously potential going into the summer that could pick up.
Is it too soon to talk about Max Kentner and HSBC and reverse Goldilocks. Payrolls report comes out. It's just one print, just one payrolls report. Wage growth looks hot. ISM manufacturing gets closer to expansion. It's just one story, just one economic data point. Services comes out, a bit hotter than expected. Prices paid picked up. Yeah, early days, January, don't put too much weight on it. CPI drops. It's just a drip feed of hotter than expected data.
If you get the same from retail sales, how much does that sort of play into this? And then the question is, Stuart, this is right for you. Is good news bad news? And I looked and said, you know, at what point does it really become a headwind? And it's not there yet. And I think that that was sort of the consensus from a lot of different analysts. Stuart Kaiser of Citigroup saying our base case remains positive on strong economic data and a dovish leading Fed. Do we, though, get a situation where bonds get blown out and stocks do well? Is that kind of the dichotomy that we're seeing at a time where inflation is a bit stickier than
Russ Kostrick, BlackRock, what did he say 60 minutes ago? We said, look at the economic mix right now. Does it favor one asset class over the other? He said stocks versus bonds. Underweight bonds, overweight equities. That's his trade at the moment.
We're hearing that from a lot of people because why would you want to own the bond? I mean, we heard that yesterday from David Kelly. You're not going to get the capital appreciation. You're going to get the coupon. If you want the coupon, go fish. If you don't, maybe go to equities.
Got a bounce in equities this morning. Equity futures on the S&P 500 positive here by 0.5%. In the bond market, yields shaping up as follows. Lower at the front end by 5 basis points, back to about 460 on a 10-year, down 2 or 3, back to about 428.68. Coming up this hour, Tracy McMillan of Wells Fargo on why it's time to get defensive in stocks and bonds. Bloomberg's Michael Shepard on the Republicans' shrinking majority in the House. And Pierre Farragut of New Street on NVIDIA's relentless rise to the top. Pierre Farragut also covering Uber and other big tech names as well, Bramo. So a lot to get into with him a little bit later.
Yeah, I want to hear about the dividend and the buybacks and whether this is the new play, that basically cash distribution is a new acquisition in tech world.
We begin with our top story. Markets shaken by sticky inflation. Futures and Treasuries signaling a smaller rebound following yesterday's slump. Tracy McMillan of the Wells Fargo Investment Institute saying the Fed is likely to put off its first rate cut until at least June and recommending investors lighten up on the top 12-month performers, including tech, consumer discretionary, and buy energy, industrials, and healthcare. Tracy joins us right now. Tracy, I just want to recap some of your calls coming into this year. You said March and a rate cut in March was too early. Looks like you're correct. You said market pricing for 150 basis points of rate cuts was too aggressive. So far, so good. Tracy, you said services expansion will fall into contraction. Now, based on what we've heard so far this year, that's one looks a little shaky. Is that still your view?
Yes, it is. We think that we will start to see some weakness in consumers, really on the margins, and we're basing this on a couple of things. First of all, we're starting to see delinquencies that are concerning in credit cards and auto loans. Mortgage delinquencies have also started to rise, and student loans are probably next. We're also seeing a labor market that is not quite as tight as it has been, January's print aside. It looks to us like it is starting to weaken on the margins with hourly or average hourly work weeks declining, and also with temporary workers also starting to decline. So that's where companies can start to cut employment on the margins. And so, we think that those two factors are probably going to play into a little weakness in the consumer and a bit of a slowdown as we move into the next couple of quarters.
What would you have to see to change your view on that?
Yeah, so in order to change our view, we'd want to see a continuation of strong labor markets, and we'd also want to see some reversal in those delinquency numbers. Like I said, autos, credit cards getting up to a level where we think that is starting to be concerning. Retail sales tomorrow, you mentioned that earlier. We would want to see those continue to come in relatively strong, although, like you said, that could be a problem for inflation. So either way, we think that the Fed is probably going to be on hold here at least until June. And so that is causing this repricing that we're seeing in equity markets.
Tracy, we've heard from a whole host of different investors that they prefer stocks over bonds in a time where inflation is sticky and we are dealing with bond yields that haven't fully reflected the fact that the Fed is just saying they're going to cut rates by only 3 times this year. Do you agree? Are stocks a better picture right now, albeit defensive, than bonds?
So we think that equities and fixed income markets are both overbought. We are actually a bit overweight fixed income at this point, but in the short-term fixed part of the curve. And we think that that is a good holding place here while we wait to see if this choppiness in the markets are going to continue. The S&P 500 has been up 14 of the last 15 weeks. And so a 10% correction at any point during a given year is a pretty normal occurrence. So we'd want to wait for maybe a bit of a reset in equity prices here before we'd want to move some of that short-term fixed income back into the equity markets.
But Tracy, we know where the leadership has been on the way up. Where do you see it on the way down?
Yeah, on the way down, it's probably going to be similar to where it's been on the way up. The largest of the large caps have been outperforming since March. They've been dramatically outperforming small caps. We think there will be a time to invest in smaller cap companies and mid cap companies, but we think that that's not going to occur until we start to see evidence of a turn in the cycle. An early cycle is where we tend to see those perform better. So we are continuing to overweight large caps and especially quality large caps.
Tracy, Lisa's been talking about the buybacks that are taking place, specifically around some of these big tech names and the smaller ones as well. When you're waiting for that drawdown, that pullback in this equity market, aren't you fighting those forces? Just how powerful are those buyback programs?
Sure, they're very powerful and they can exert upward pressure on markets. We think that that is going to counteract to some extent the weight that higher inflation and the Fed on hold for longer will exert on markets. And that's another reason why we're favoring companies that have good cash positions, companies that have low debt, because those are the ones that are more likely to initiate these buybacks and potentially continue to rise, even if the benchmark index as a whole is exhibiting some weakness.
I was struck by Instacart in particular because they're talking about laying off a significant part of their workforce while also increasing dividends and authorizing share buybacks. Is this what we're going to see, that potentially companies and stocks are going to keep doing well even if the economy starts to sour more materially?
That is a possibility. Certainly fourth quarter earnings were positive for the largest of the large caps. But now companies are starting to say that they're more wary, less confident that they can pass along higher prices. So we do think that that could weigh on margins, and that's probably why you're starting to see some of these cost-cutting efforts, which include reducing the size of their workforce. And eventually that's going to weigh on the labor markets and the consumer. And so, all of this is going to counterbalance some of the positives from the cost cuts.
Hey, Tracy, appreciate the update on some of your calls. Thank you. Tracy McMillan there of Wells Fargo. We talked about small caps briefly. As Lisa mentioned earlier in the program, small caps yesterday, the Russell, down 4%. I was surprised to see that was the biggest one-day drop going back to 2022. That even going back to, say, spring of last year when we had the regional banks getting absolutely battered, that we were down some of those days by something like 3%. Yesterday was absolutely dreadful for small caps.
Which raises this question of whether we have the narrative a bit wrong. Who was it who came on the show and said, you guys are missing the plot? You saw a 30% rise in small caps heading into the end of last year in response to this idea of the Fed's pivot and just sort of this Goldilocks narrative. If you're seeing a little bit of frost taken off the top, okay, it's because of worries about some of the hangovers from debt and things, especially in a higher for longer kind of environment. This is going to be one of the big debates. When do they start turning around? When is the economy strong enough, and when is there rate security where you understand where things are going to get conviction?
Chris Verone, strategist.
Thank you.
I don't think he had that hot CPI print in mind when he made some of those comments. Broader equities right now positive by 0.5% on the S&P 500. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Defense Secretary Lloyd Austin has been released from hospital after undergoing a procedure for a bladder problem. The Pentagon says he will work from home until later this week. He had canceled a planned trip to Brussels to meet with other defense chiefs and will now join virtually this morning. Austin was hospitalized in January following complications from prostate cancer, an episode which sparked furor because he waited days to inform the president and Congress. Donald Trump will likely drain his war chest for legal fees this summer. It leaves the GOP frontrunner crunched for cash ahead of November's polls. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July. Just as the RNC triggers the official start to the election campaign, it forces the frontrunner to tap the party or donors for more cash. UniCredit will increase its overall bonus pool for last year by about 16%. The Italian lender posted record profit and increased shareholder returns. The average gain per person will be higher than 2023, given the job reductions, with increases between 9 and 27%, according to sources. It also bucks the trend in other European investment banks who are planning to reduce pools after a challenging year for their securities units. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on this program, Democrat Tom Suozzi winning New York's special election.
Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
That conversation up next, live from New York City. This is Bloomberg.
On the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
Stocks bouncing just a little bit on the S&P 500, positive here by 0.5%. Euro totally unchanged. Bond market rewinding some of yesterday's move. We're down about 2 basis points after climbing double digits through much of the curve yesterday. 429.27 on a 10-year this morning. Under surveillance this morning, Democrat Tom Suozzi winning New York's special election.
It's time to move beyond the petty partisan bickering and the finger pointing. It's time to focus on how to solve the problems. Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Here's the latest this morning. Swazi replacing ousted Republican George Santos. The win cutting the GOP's already razor-thin House majority. Republicans currently holding 219 seats to Democrats 212. Bloomberg's Michael Shepard joins us now out of Washington, D.C. Mike, let's go to those numbers. How much of that was a referendum on Joe Biden?
You know, that's a great question, and we were kidding before the break about the snow, but really this was, that fell in New York yesterday, but really many have been looking to this election as something that would say more about what's going to happen in November between Joe Biden and Donald Trump. This is the rematch that nobody has wanted, yet we're all heading toward, but also what it means for the two parties as they try to gain control of these two closely contested chambers here in Washington on Capitol Hill.
It's an unnerving margin now that Speaker Johnson wakes up to. How does he deal with these kind of numbers when he wants to put very partisan bills on the floor, like the one last night to impeach Secretary Mayorkas?
Well, Emery, you hit the nail on the head right there with Mike Johnson's problem. This is the last thing he wanted out of this special election. He's already been dealing with this narrow margin. He can only afford to lose two Republicans on any party line vote. And as you mentioned, this Mayorkas impeachment, it lost a couple of Republicans who were questioning whether it was justified and whether they had enough under the Constitution to proceed. So if Mike Johnson runs into any tight spot where he needs Republican votes, he runs the risk of falling short potentially again and again if this issue comes up. Tom Suozzi hasn't been sworn in yet, but once he is, the margin will be 219 to 213.
Tom Suozzi used to be known as Mr. Salt. I feel like after the special election, he's known as Mr. Border. He was saying he would shut it down. He was saying he was bucking trends within his own party. What message does that send to the Biden campaign about how important the border issue, given the fact that this was a top election issue for voters in Long Island in the northeast of the United States?
Well, Emery, immigration and the border are really top issues across the board. And in our Bloomberg Morning Consult swing state poll, we found that 6 in 10 voters blame President Joe Biden for the troubles that we're seeing at the border with this surge of migrants crossing and just this sense nationally that the situation there is out of control. And certainly in New York, which has had to absorb 170,000 migrants in recent years, many of them shipped up there by Texas Governor Greg Abbott. All of that is coming home to roost in traditionally Democratic areas like New York. And voters there, even Democrats, are wondering, what is the president going to do? What was interesting in Suozzi's remarks last night was that he was addressing Republicans and flicking at the issue of immigration. He said, we need somebody to get things done. He was addressing people on the other side of the aisle. And you recall that Republicans walked away from the bipartisan deal on the border that included aid for Ukraine, Israel, and Taiwan. And it was one that Biden had agreed to and was ready to sign. Yet under pressure from Trump, they backed away.
Is there a lesson in this, Michael, that basically people who are known can get reelected, people who are not known are that much scarier after George Santos?
Well, I'm glad you asked that, Lisa, because in this case, Suozzi was really well known to the district. He had represented it for 6 years. He left Congress after 2022 to run for governor. Didn't work out. He sought the Democratic nomination that Kathy Hochul won, but his brand name still held some sway there. And what's interesting is that in Nassau County, Republicans really control the political apparatus there. The district spans both Queens and Nassau County, so he would be the lone county-wide, in a way, representative from the Democratic Party, and he will be representing them in Congress this time. His familiarity with voters certainly helped. And it also helped him raise money, and it also helped him with spending, too. He was able to outraise his opponent, Mazi Pilip, I think, by a 3-to-1 margin.
Let's talk about the weather. That didn't count as snow. I'm sorry. That was slush. They fell from the sky, and then that melted by 2 p.m. Are we really blaming that, or is basically there just a complete lack of enthusiasm right now and low turnout all around?
Well, there is one question about this election, the 2024 election, too, about whether voters are exhausted, whether they have had enough of politics. The snow may have kept some people home in the morning, and certainly Nassau County the Nassau County executive flagged that as an issue in discussing it yesterday. He said, look, in the morning it was a little rough. He said that turnout picked up in the afternoon as things cleared up. But it was more than just the weather, clearly. People are a little fatigued with politics, and yet the stakes are very high entering this election as we head into a rematch of Joe Biden and Donald Trump.
It's the rematch not many people wanted. You see it in poll after poll. You look at the dysfunction down in Washington in Congress. It's increasingly frustrated. This is why there's so much fatigue, Michael. People are sick of it. We've been talking about deals that can get through the Senate but can't get through the House, things that can get through the House but can't get through the Senate. Can we talk about something that might pass both chambers, and that's a bipartisan tax effort? Michael, how close are we to that taking place?
Well, we seem to be inching closer and closer. One of the issues has been how this all gets paid for, and they are working this one through the process now. We're hoping for a little bit of action or movement later this week, but I will never bet on Congress doing anything on time or on schedule, especially with the tight partisan margins. There are some Republicans who are concerned, in particular, Anne-Marie brought up SALT, the state and local tax breaks that Democrats in particular are looking to restore. Those favor, the metropoli and the suburban areas of the nation. But for a lot of Republicans, they feel that benefits Democratic districts and states more than Republican ones. Hence, they're a little bit more hesitant to move through on something that has that provision.
Hey, Shep, good to catch up. Thanks for coming into the office for us early. Michael Shepard there of Bloomberg down in Washington, D.C. The constructive way of framing this is a feature of democracy, not a bug. You don't want it easy, Bramo. It's meant to be messy.
Okay, I actually adhere to that.
Don't want some dictator saying, this is the bill, this is the law.
You have to have people who are willing to consider the law before they vote on it. I mean, there is a difference between, the messiness that is built in and a feature of democracy, and a messiness that is just a feature of politics and people trying to, create a certain image for TikTok or Instagram or Twitter.
You're suggesting it's the latter and not the former then currently?
It just feels a little bit different when people aren't even willing to consider the actual line items or discuss them. They're just talking about some kind of blanket ideology that is just going to mean no.
It's also much harder now for lawmakers to reach across the aisle and get a bipartisanship bill done, in the fact that we're getting ever closer to November election. Do you remember, though, we did have bipartisanship previously. We had a hard infrastructure package, and we had the CHIPS and Science Act. When Congress has had to act in certain things they've really wanted to get done, they were able to. But the closer we get to November, every single decision you make is going to become political.
Good policy isn't good politics the closer you get to the election. Isn't this what's basically winding you up right now?
Honestly,
that and the snow.
Yes.
You seem to be furious about the snow yesterday, the fact that it was hardly any.
Well, it was not good snow.
What would you describe as quality snow?
My family lives in this district, and they said it was cleared by 2 p.m. Yeah. There's no issues voting. It was lame. It was lame
slush.
Snow.
It fell. It was wet.
It didn't
the
warm
kids
a
went
snow
out
day.
there. They sled. They
Right.
get mud all over because they're basically just sledding in a mud patch.
Of course.
You go into Central Park. It looks like Times Square. Everyone's trying to sled on tiny little patches and build small little snowmen. It was just not accurate.
Are you suggesting that Eric Adams wouldn't make a good meteorologist either? Is that what you're suggesting?
You're just trying to wind me up.
No, I'm just asking. They're just questions.
Look,
they're not loaded.
They're
not, of course they're not.
All right.
They're just questions, Bramo. It's all they ever are.
Oh, yeah, always.
Coming up, Pierre Ferragut of New Street Research on NVIDIA's meteoric rise. That's coming up next from New York City. Stocks are positive. This is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the two big juggernauts with Barbie and Oppenheimer, movie-going begets movie-going, right? So when there's a season filled with, good movies that people want to see, I was made to feel pretty optimistic about what we saw in the summer.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
The stock market's bouncing back here, as Lisa pointed out a little bit earlier this morning. The Russell of small caps yesterday down 4%. Biggest one-day loss going back to the summer of 2022. The Russell this morning up by a little more than 1%. Futures bouncing back on the Nasdaq as well by 0.65. On the S&P 500 higher by 0.5%. In the bond market, let's switch up the board and go to the 2-year. Take a look at the front end of the yield curve. We've had a move so far year to date of about 40 basis points. Down 3 basis points this morning to 462.65. What's interesting about the last 24 hours versus, say, things year to date, Lisa, over the last 6 weeks, is that yields have been repricing higher all year off the back of firmer than expected data, but equities had held up until yesterday after that CPI print.
It seemed to be maybe a gut check or a gut punch, as some people would say, when you take a look at inflation running hotter than expected and running hotter than expected across the board. So you asked a really good question yesterday. Is this more of a market problem than it is a Fed problem? Because this is exactly what they've been saying. It raises this question, though, especially if there's a broadening out in services inflation, about how long higher for longer really is. And frankly, it does raise the question of just how sticky inflation is that a lot of people thought kind of was transitory.
For Fed officials right now, I think they can carry on saying the same thing. This is exactly why we wanted to wait for more good data. We didn't say anything about June. If anything, we said no to March, and we can push that back a little bit further as well. Those 3 cuts, they still look okay. I think they still look okay for 2024. Can that change in the next couple of months? Sure, it can. But the market was priced way more aggressively than that. And I'm not just talking about, what David Kelly at JP Morgan Asset Management said yesterday. I totally understand. The market pricing is a collective sort of average of a whole range of views, a hard landing, a soft landing. That 4-5 rate cuts doesn't speak to something super precise. But equities at all-time highs and spreads incredibly tight and yields coming back in, the so-called everything rally of the last 3 months, I think that speaks to the soft landing that the consensus view was kind of looking for.
And just to build that out, because I also like that, it's basically saying that there are people who are looking for a hard landing, and then there are people looking for a soft landing, and it's the average of the two, and the people who are looking for a hard landing are kind of getting blown out, sort of like that's not looking likely right now. So this raises the question, to Stuart Kaisers' point, how much does this really start to discuss or lean toward overinflating in some sort of significant way? That, I think, is what markets are grappling with a little bit more now.
So the UK was wondering whether they'd be spooked as well by hotter than expected inflation data. They weren't. If you just turn the board and go to sterling a little weaker against the US dollar, 125.55 on cable. We're negative by 0.3%. We were looking for something like 4.1 year over year. We got 4. Month over month, we were looking for negative 0.3. We got negative 0.6. So the right kind of downside surprise in the UK, with people on the MPC at the Bank of England still voting for rate hikes, a couple of them anyway, out of the 9. I think those hawkish wings got clipped by that data this morning.
And people are now calling for in next month or the month after, you're going to get some sort of rate cut from the Bank of England. It kind of highlights how different the inflation story is, though, in each region, right? It's not the same across the world, in the same kind of supply-driven inflation shock like what we saw say, a couple years ago.
We're still waiting for the Bank of Japan to start hiking interest rates.
Yeah, maybe that'll happen.
Everyone else started a few Decembers ago. Under surveillance this morning, our top story, global bonds erasing all of the gains they made since Fed Chair Jay Powell's December pivot. Stickier than forecast CPI data in America, dashing investor hopes that the central bank would start cutting interest rates sooner rather than later. Later today, we'll hear from Chicago Fed President Austin Goolsbee and Michael Barr, Fed Vice Chair for Supervision. And Lisa, we've already touched on this, but ultimately, are you expecting any kind of change of communication from them whatsoever based on yesterday's print?
You know, I was wondering, does this matter, right? Is there going to be anything relevant from these comments? And there will be. And I think that it's compelling to me that a lot of analysts and economists are saying it's important to note whether or not they start to say this is just one data print. If they do, that can be viewed as somewhat dovish, and you can start to see that pushed into markets where, okay, expect them to cut rates in June and then progress with their cycle from there. If they don't, if they say this is concerning, or we need to look more carefully, or we want to see Supercore come down more aggressively, that's going to be treated as very hawkish. And I think that that's really what's going to tip the scales in markets today, potentially.
First reaction from the Federal Reserve, as Lisa points out a little bit later this morning. The latest on the politics, the House voting by the narrowest margin possible to impeach Homeland Security Secretary Alejandro Mayorkas after failing in their first attempt just last week. Mayorkas becoming the second cabinet member in history to be impeached. The last one was nearly 150 years ago. The effort is likely to die in the Senate, where a two-thirds majority is needed to convict and remove him from office. Anne-Marie, this is what we were talking about all morning. There are things that the House are able to do that the Senate just won't go with, and vice versa.
Well, this is politics, not policy. And the House really had to take up this bill again because it was an absolute embarrassment for Speaker Johnson to put something on the floor that he promised his base he would do and then not have the votes at the end of the day to shore it up. To get this across the finish line, we cannot just imagine how tight these numbers are. Steve Scalise is undergoing treatment for cancer, for blood cancer. He came back to Congress to take this vote. If Tom Suozzi was there in his new sworn seat he's going to have, that vote would have never went through. That's how tight the margins are right now, and that's why it's going to be really hard to get anything done in a bipartisan way, especially closer to November.
That margin gets slimmer and slimmer. Let's finish on this story, a lighter note. For Jeff Bezos anyway, the Amazon founder and chairman selling $4 billion worth of the company's stock in just 4 days. Prior to the sale, Bezos hadn't sold shares since 2021, the year he stepped down as CEO. Bezos still has a significant stake in the company, holding approximately 9.3% of outstanding shares. Amazon stock up about 11% so far this year. Anne-Marie, you went through the numbers. I want to hear those numbers again. The tax implications, or lack thereof, of doing this now versus before.
So he left Washington State and went to Florida. In Washington State, if you have gains above $250,000 from the sale of these capital gains tax, sales of shares, 7% is what you're taxed. 0 is what you're taxed in Florida. So if he was ever thinking of unloading, it would obviously be wise to move first and then unload. You could buy a lot more.
4 days, $4 billion. Can you imagine?
Yeah, and the savings, likely $288 million so far.
Oh.
So it raises this question, what's he going to do with it?
A lot of stand-up paddle boards.
Yeah, I don't think so. I think that there's some other things.
Lots of photos of him.
I'm sure that there's lots of other things, too.
What are you suggesting?
Well, I mean, he's got yachts, he's got islands, he's got, stylists.
Building rockets.
Building rockets.
Yeah.
I mean, what's
that
next?
Forever clock, which is pretty cool. Have you seen that?
No, I haven't seen that.
You should take a look at that.
Forever clock.
That's interesting.
I spent a lot of time yesterday looking at that cruise line because there was all this discussion.
Yeah, I'm not sure that Jeff Bezos is going on that cruise line anytime soon.
He has his own cruise line.
He could afford, though, if he wanted to, just to sort of charter it for a month and take the family on it.
Definitely.
It'd probably be a very lonely experience.
Take all of Amazon on it.
It's so big.
His family.
How many street blocks was that?
It's
like
it's
3, 4, 5, 6.
You see it, it's parked in there. It's just basically a skyscraper.
I think my sort of idea of hell would be to go on that cruise ship. What was it? Icon of the Seas.
Icon of the Seas.
Icon of the Seas.
Yeah, it was actually an article. It was a Wall Street Journal article talking about doing it without the add-ons and what that would be like.
Okay.
I found it very compelling.
This is not what Pierre Ferragu wants to talk about, so let's talk about something he will want to discuss. A new year, the same story. NVIDIA leading big tech higher, yet again, after jumping more than 200% last year, adding roughly $500 billion to its market cap, surpassing Amazon. It's become the world's 5th most valuable company and forcing analysts across Wall Street to chase this rally. Pierre Ferragu of New Street Research joins us now for more. Pierre, talk about chasing it. UBS have gone from 580 to 850 price target. Mizuho's gone from 625 to 825. I think the last time I looked, you were at 700. Can this name, Pierre, keep beating and raising through 2024?
Good question. I think when it comes to earnings momentum, things for 2024 look very, very, very solid, very good for NVIDIA for a very simple reason, which is that there are way more people who need GPUs, who want to buy GPUs, and their supply chain can actually provide GPUs. So no risk on pricing, very healthy demand. And it's just a game for them every quarter to do as well as they can on their supply chain and on manufacturing. And so, when you're looking at manufacturing, you're guiding for the next quarter, you're being cautious, you're looking at the worst case scenario, and your execution is better, the execution of your suppliers is better, and you end up bidding. And so I think we're going to continue to do that, to see that. Now, if I'm telling you that, and if I've been telling you that for the last maybe 15 months, it's that it becomes very visible, and everybody knows it. And now the question is, how much of these bids are already in the stock after the rally you just mentioned? The stock is up about 50% year to date, and it tripled last year. So even if we see an addressable market that is growing very, very fast, we expect that the market is also doubling year on year and doubling again year on year and doubling again year on year. So it's difficult to know exactly where the rally stops, but very clearly the stock is already anticipating a lot of these revisions.
Pierre, it feels like an AI chip-related frenzy in the equity market. I was just going through your coverage list. You've got a buy on ARM, on NVIDIA, you've got a buy on Intel, you've got a buy, I think, on Broadcom, you've also got a buy. There's a neutral on ASML. Can we talk about that just a moment, Pierre? Where does that neutral come from? Why are you so constructive on almost the complete universe, but not that name?
Let's take a step back. The AI market, this year it's going to be like 80 billion, and AMD said in 2027 it could be 400 billion. So a business that can quintuple in 4 years is good for everybody. So you should expect to have buy ratings on everybody. Now, when you look at players like ASML, AMAT, Lam Research, Tokyo Electron, so the guys who really sell the equipment, what we see there is that today they do almost half their business from China, and they do another very large chunk of their business, another 20-25% from the lagging edge, so lagging edge chips. And what we see today is that we think China is at risk. There is a lot of pressure for China to spend less. So we don't say it's going to happen, but we say it's a very high risk. And we think the lagging edge has been overspending for a year and is now very clearly cutting capex. Players like Infineon, Analog Devices, Texas Instruments, ST Micro, all these players are cutting capex. And so we are just like a tad cautious on an ASML, on an AMAT, and we just say they're going to benefit from AI. I mean, in order to build 400 billion chips in 2027, we need to spend ahead of that $50 billion in wafer equipment in order to have the production lines ready. So there is going to be a lot of business coming from AI, but it's going to come at a time where the majority of their business of today is actually going to pull back. And that's the reason why we are more cautious on the equipment players. The only one on which we have a buy rating is KLA-Tencor, and for the simple reason that KLA-Tencor is very, very little exposed to the lagging edge and to China compared to other players.
Just quickly, Pierre, I'm curious how much you're looking for dividends and share buybacks as announcements that could potentially support some of your buy recommendations and the others, not ASML, especially given what we saw from Meta, given what we just saw from Uber, and given what we've seen from a whole host of others.
I don't really have that on my radar screen, to be honest. You look at, if you're NVIDIA today, you have this idea that maybe your addressable market could be $400 billion in 2027. But if you're honest about it, you have no idea, right? It's like we are discovering what AI could be, how fast adoption could grow, how fast models are growing, how fast usage is growing. So this $400 billion scenario is a possibility, but it's only a possibility. We could end up halfway there. And NVIDIA has no control on that. Google has no control on that. Microsoft has no control on that. It's going to be a game of how fast the services are being adopted and how fast also the services are progressing. And so if things slow down, like for instance, you saw yesterday in the Wall Street Journal a report that people using the Copilot of Microsoft with the Office suite were a bit disappointed. If things slow down a bit, you could end up having a market of only 200 billion in 2027. Or like it will still be like amazing, a market going from 80 billion to 200 billion. And if that happens, you'll see a lot of turbulences in the stock. So is that a good point in time to look at buybacks and dividends? Maybe it's still a bit early. That's what I would say. But
yeah, just to jump in, I know you cover Uber. I just wanted to finish there. What did you make of that buyback from them this morning?
Well, you know, when even before Uber IPO, we said in that ride-sharing business, it's very easy. If you manage to get the largest market share, only a single competitor will survive and will be like, you know, on oxygen to survive, will have a very hard time, and you are going to become a cash machine. And that's exactly what has unfolded over the last 4 years. And if you are a cash machine and, you know, the street is still relatively cautious in the way it values your business, one of the best use of your cash you can do is to buy back your own stock, because with low multiples, buying back is actually very, very efficient. So, you know, that's music to our ears. We're so happy to see that Uber is really playing out the way we were expecting, and we still have a very positive view on that name.
The stock is positive this morning, up by 6%. Pierre, wonderful to hear from you, as always, sir. Pierre Faragoud there of New Street Research on NVIDIA, some of the names elsewhere in that universe, and Uber this morning with its first share buyback. Bramo, that stock is up by about 6%.
I guess that if they have the cash, that's what people are doing with it. I think that share buybacks are running at something like the hottest pace ever in a February to start a year.
A $7 billion share buyback. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Shares in Airbnb are lower this morning after the company reported strong fourth quarter results, but did suggest early 2024 demand is waning. Earnings from the company initially came in strong on the back of continued post-pandemic travel demand, but Airbnb expects the number of nights and experiences booked that it will likely moderate this quarter as demand normalizes. Lyft stock has been on a wild ride since yesterday afternoon. The ride-sharing company posted earnings that beat estimates, but a clerical error in its press release caused the stock to surge a whopping 67%. Since then, it's come down to about 19% in the early trade. The mistake, an extra zero in Lyft's forecast for margins. The error listed margins expanding at 500 basis points instead of 50. I spoke to Dan Ives of Wedbush on the brief earlier this morning.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through. And I think it's been really a comedy show that we've seen at Lyft for years right now. And this is, even though it was a good quarter, it overshadowed by another black eye moment for Lyft.
A SpaceX rocket carrying a robotic moon lander has been postponed for 24 hours. The mission is now targeting a launch early Thursday morning Eastern time with its Intuitive Machines-built Nova C aircraft payload aiming to touch down on the lunar surface about a week later. If successful, it will become the first privately built spacecraft to land on the moon. And that's your Bloomberg brief. John.
Danny, thank you. Appreciate the update. Up next on the program, and an even road to 2%.
There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down.
The latest reaction to that hot inflation print up next.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? Are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
One hour and about 41 minutes away from the opening bell. Equities bouncing back from the losses of yesterday. Equity futures on the S&P 500 positive by 0.5%. Yields lower by almost a basis point, 430.45 on a US 10-year. The surveillance this morning and an even road to 2%.
From my perspective, all it says is, okay, the economy is cooling, it's just cooling more slowly. There are certain aspects of this report which push the numbers higher. But overall, as this year goes on, we think the economy is going to grow more slowly. We think inflation is going to come down on a year-over-year basis.
Here's the latest today. Hot inflation data erasing the last of the global bond market rally that began in December with Chair Powell's pivot. Colin Martin of Charles Schwab sticking with his initial forecast, writing this. This report throws some cold water on the Fed's rate cut plans. We've been expecting 3 to 4 rate cuts this year anyway, so now we're aligned with market expectations. We never bought into the aggressive pace of rate cuts that were being priced back in December and early January. Colin, I'm pleased to say, joins us now. So we've had this conversation, Colin, and good to see you, by the way, as always in person. We've been talking about this over the last 24 hours. Was this a bigger surprise, do you think, for the market than it was for, say, Fed officials?
I think so, just based on the market reaction. The market reaction, I'd say, was warranted. When you get a stronger than expected report like that, pretty much across the board, you're going to see markets react, especially given the expectations for those cuts. Now, they've been tempered a little bit. If you look at the Fed, if we go back to what most of the officials have been telling us, they've been talking about patience. I mean, that's what Powell told us, the need for more time, the need for more data. They want to be assured that inflation is moving down to 2%. And this kind of gives them a little bit more time to reevaluate the landscape and see what'll happen going forward. We thought March was too soon. We're still kind of in that May camp right now. I think the odds are about 1% or 100% or so for May as opposed to June, based on Fed funds futures. We'll see how the next few months of data pan out, but we still expect 3 or 4 this year. We don't think this is a turning point. We don't necessarily expect a reacceleration in inflation.
Just to talk to the point that David Kelly was making, that it wasn't that the market was thinking we were going to get 6 rate cuts. It's that it was something between 12 rate cuts and 3 rate cuts, and sort of speaking to this idea of the potential for a hard landing. Has the market fully priced out a hard landing at a time where we're looking at data coming in hotter than expected, where we see the growth just coming in, again, stronger than expected?
I think you could argue that they've priced out a hard landing based on some of the market-based indicators like credit spreads, like the stock market. Sorry, my thing's falling out here, Lisa. Stock market at an all-time high, over 5,000, obviously came back a little bit. What really surprised me yesterday was despite that stock market action, we saw credit spreads tighten. We saw high-yield bond spreads tighten. So if you look there, that to us is indicative of a healthy economy. I mean, otherwise, you'd see investors, you'd see lenders expecting and requesting higher spreads, and that wasn't the case. And that really shocked me yesterday, that despite all that volatility, despite the potential for higher for longer, that we saw spreads fall even more.
We were speaking earlier this morning with Rich Kosturek, and he was talking about how he's underweight bonds, partly because you are seeing the strength and you are expecting it to be a higher for longer environment. Do you agree that in the duration set, that in longer-term treasuries, you see a bigger risk right now than you did, say, a couple weeks ago?
We don't see that. We're still in the camp that investors should gradually extend duration. We have a more long-term view, so if yields go up 20 basis points or so in the next week or so, that's not going to change our opinion. We'd have to see yields, sustainably move higher, and that's not really our base case right now. We still see a lot of our investors, a lot of our clients at Schwab in very short-term investments. And even if the timing of that rate cut gets pushed back a little bit, we think investors should still kind of move out a little bit and lock in those yields. Because again, we don't expect a reacceleration in inflation. We don't expect the 10-year to get back to that 5% level we saw back then. So we're not underweight bonds. we still suggest investors move out a little bit on the yield curve. As it relates to credit, we're pretty much neutral across the board. The stronger than expected economy, the resilience we're seeing is obviously a good thing for corporations, but it's valuations that really get us a little hung up there, and why it holds us back a little bit from being more enthusiastic and from going overweight.
This conversation often gravitates to a discussion about the fundamentals. Can we talk about the psychology? So back in October, when yields were through 5%, no one wanted them. You drop towards 4, everyone's piling in. And then everyone's told Lisa and I over the last 2 months that if we get a backup in yields, we want to buy. Okay, well, we've had a backup in yields of more than 40 basis points. What are your clients doing now? Are they still just sitting there in cash hoping we go up another 20? Another 50? What are they doing?
Well, I don't know what the number is, but yes, they are. And we hear that. And I think to psychology and behavioral ideas there, we kind of get anchored to that 5% we saw last year. And I know that's a level that a lot of investors were waiting for. And as you alluded to, no one really dove in then. I think there's 2 things. One is the hope that yields get back to that level. And I think a lot of investors, though, number 2, are probably a little bit scarred of what happened in 2021, but then more so in 2022. You go in now at, say, 4.25%, 4.3% on the 10-year, but then let's say yields do go up. That would be a big hit to the value of their bonds. So you have the hope for higher yields, and you have the skittishness, I think, of the potential price declines. So we are still seeing a lot of our clients focus more on the short end of the yield curve.
How low would yields have to go before you kind of shifted away from duration?
Maybe 3.5% or so before we get a little bit more cautious there. When we look at what the 10-year Treasury yield is right now and where it should be over time, based on our outlook for more of a soft landing, I know there's the soft and hard landing discussion. We're probably somewhere in the middle. We see rolling recessions. We also see rolling recoveries. But the yield curve inversion that we're seeing right now is not normal. I mean, from the Fed funds rate to the 10-year Treasury yield, it's near the lowest we've seen in decades. So assuming we get Fed rate cuts not because of a recession, just more for a normalization, we expect short-term yields to fall a lot more than long-term yields, and the 10-year might settle on that 3.5% to 4% area.
Interesting. Colin, appreciate the input, the insight, the reaction from the team at Charles Schwab. Colin Martin there, 2-year versus 10-year right now. Lisa, still negative, about 32 basis points.
It's de-inverted, though, quite considerably, considering that people have, you've seen both sides really come to the fore with short-term yields coming in for the most part over the past 6 months.
If you were looking for that aggressive bull steepener, though, that big rally at the front end off the back of terrible data or really tremendous inflation data to encourage the Fed to start cutting interest rates, not seeing it.
People don't understand this cycle, including myself, right? What the Fed's reaction function is going to be, how much they're going to cut, and then what longer-term inflation rates as well as the risk premia are going to look like. This is all unknown. We're territory unknown at this time.
You're not alone. Hardly anyone understands this cycle.
And it's really confusing.
2-year yields coming in about 3 or 4 basis points at the moment. That move's fading too. In the next hour, the third hour of Bloomberg Surveillance, Deepak Puri of Deutsche Bank, Ed Mills of Raymond James, and the brilliant David Rubenstein of the Carlyle Group just around the corner.
Julie Swinehart is supremely skilled at navigating the rapids of real estate. That's important because real estate development is the next frontier in the business of sports. Fenway Sports Group has a blockbuster project in the works.
We have 5 acres to play with here. And when all is said and done, we expect 2 million square feet across residential, commercial, retail.
Given the track record of Messrs. Henry, Werner, and Gordon, the Fenway Corners plan comes with high hopes of success. That doesn't mean it will be an easy lift, especially right now.
What have you learned with the dynamic move of the interest rates? Do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
Julie Swinehart took me on a walking tour into the future.
This is going to become the true entrance to Fenway Park, and that's part of the attractiveness of this project is the age-old recipe of increasing dwell times, bringing fans to the park, bringing in businesses, maintaining what's here and preserving some of the historic nature of what you see around you, but making it even more accessible, making it more fan-friendly.
Nobody brings you top names like Bloomberg.
The point is that the economy is doing very well in the Netherlands, but the election was very much focusing on migration.
They had made 26 attacks. We'd given warning after warning, but we hadn't taken action.
Parliament has to stick to this and has to comply with the debt brake. The debt brake is really a good ally.
I think we have made addressing inequality a key sort of driver of our policies.
Bloomberg. Context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some point that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in. Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
Fed is signaling to us that they're going to be very prudent about not lowering rates quickly.
I think the Fed's made the right choice. They can mute volatility with having a lot of bullets left in that gun.
The Fed is not going to make a decision based on one data point. They're going to take the totality of the data and they're going to look at it when they make a decision.
I think it's going to be patient until they're very confident that things are heading in that right direction.
We're still thinking we'll avoid recession, so 3 rate cuts is what we get.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg. Alongside Lisa Abramowitz, together with Anne-Marie Hordern, I'm Jonathan Ferro. Bouncing back just a touch on the S&P 500, up by 0.5%. Big losses of small caps yesterday, down 4% at the close, up by something like 1% a little bit earlier this morning. The hits keep coming, Lisa. We need to talk about job cuts. This time, it's Continental.
Yeah, coming out. It is a German company cutting 7,150 positions. It makes auto parks, and it's talking about how it can cut costs. Pause. We've been hearing again and again job cuts at a time where employment rates are incredibly high, unemployment lower. JOLTS data came in, job openings came in hotter than expected. I understand this is in Germany,
sure,
not in the United States. But what's correct? These headlines or the numbers? How do you square the two?
I'm thinking of many companies stateside as well doing the same thing.
Exactly.
And then you look at the data, jobless claims, looking for 220 on claims when they come out. Later this week, up from 218. Unemployment's been south of 4% for 2 years. And we've seen example after example in sector after sector.
It's upside surprise after upside surprise. And you see job cut announcement after job cut announcement with hundreds of thousands of jobs cut, in particular from tech companies. Here's my question. How messy does it become to understand job cuts given the churn having to do with technology, given the churn due to different skill sets, due to the churn that a lot of companies have been holding off on executing until they had a better sense of the stability of the economy?
AMH, it makes the communication effort down in Washington even harder.
Yeah, it does, because you're trying to explain that, to your point, Jonathan, if unemployment has been under 4% for 2 years, then why are we seeing some of these job cuts? And then, of course, inflation. This has been the issue that has really rattled this presidency. And when you look at basic goods, especially food going up, dining out, electricity bills, obviously I've been talking about the only gem is that gas prices are going down. this starts to have an impact on consumers. Every single day they go to the grocery store, and that is what is so concerning. But of course, you have to remember, is this just, I saw a lot of people on Twitter yesterday talking about seasonality, because it's the start of a new year, and there's gonna be price adjustments. And Janet Yellen, the Secretary of Treasury, came out yesterday and said, look where we were and where we're going. And she's really loath to just comment on one report.
Not just shaking that equity market, that bond market too. And by the way, Treasury Secretary Janet Yellen, if that was a good print, they'd be talking all day about it. It's a bad print, it's only one data point.
Yeah.
If it doesn't fit the narrative, it's easy to discard, right?
Well, I mean, right now, probably more than ever, but that's one reason why a lot of people pushed back in their notes saying, you might not want to really just chalk this up to total seasonality.
Max Kettner, HSBC, he's been on top of this. Reverse Goldilocks. Any further signs of stickiness and inflation would bring another wave of reverse Goldilocks. We got a wave of that right the way through this market yesterday.
People trying to price in what a no landing scenario starts to look like. Don't you love this? This is such a fun game. No landing, soft landing, hard landing, but that's where we're at.
That's what we played how many times last year?
Lots of times.
I think this time last year we were in the no landing phase.
I think we're back there.
Right before the hard landing phase of March, when banks started to fail. It's almost like a repeater to, I'm not going to say any banks are going to fail, but it's like where we were 12 months ago.
I was thinking the exact same thing this morning. I was thinking, okay, so we went from soft landing to no landing. What's next? We should have a wheel.
We should
just spin it.
It feels like a ridiculous game with no prizes. Equities right now on the S&P 500. Session highs positive by 0.5%. The bond market looks like this, yields lower by 2 basis points, 429.66. The next hour looks a little something like this. Coming up, Deepak Puri of Deutsche Bank on Wall Street's inflation wake-up call. Ed Mills of Raymond James on NATO becoming a political powder keg. And Bloomberg's Ira Jersey weighing in on fake rate cut expectations post-CPI. We begin with our top story. Inflation catching Wall Street off guard. Deepak Puri, America's CIO at Deutsche Bank International Private Bank, saying this: the strong CPI number, alongside last week's jobs report, will reinforce the Fed's view that a cautious approach will be needed. Our expectations remain that June will be the month where the first cuts will be seen. Deepak is with us around the table. Deepak, good to see you. What needs to happen between now and June to make that a reality?
Well, thank you, Jonathan. It's great to be here. I think the first thing that needs to happen is we need to avoid getting the prints like we got yesterday. But I think if you dig a bit deeper, it's really the labor market's dynamics, because it's not really the headline number or even the core number that hurt the investor sentiment. It's the super core. It's the services ex shelter that really drove this narrative that the disinflation traction is not really as embedded as what we were expecting. And why is that? That's really driven by your consumer discretionary spending. And given the labor markets are so tight, average hourly earnings took a uptick last time around, it's hard to see how the super core can come down to a level that be digestible for the Fed, especially Jay Powell, who has talked a lot more about super core, and that be the precondition for a rate cut. So I think you really need to see a couple of things. I'm fairly certain that the physical goods inflation is there, the energy being the wild card, I would say, but it really hones down to the super core inflation that needs to materialize.
So ultimately, absent that, what is the real risk, the very real risk that inflation stabilizes above target, and why isn't that your base case?
Well, as I said, there are a lot of things that are happening. Just because it's one data point, the disinflation traction is there with us. I don't think that's going to go away anytime soon. What yesterday's number has told us that we shouldn't count on it. It's not going to be a linear single-line decline on inflation front, and we need to be prepared for these kind of aberrations in the markets. And I think anyone who's thinking of this Goldilocks scenario, my concern now is that the Goldilocks can be can hurt on both sides. A, inflation can start to reaccelerate, which we saw yesterday, and B, the growth can start coming down. And I think markets probably not priced in for that.
Right now, it seems like the people who we speak to say, really the only solution is to buy stocks, particularly in the U.S., because right now you're looking at inflation that does seem to be stickier on the heels of growth that does seem to be better. Do you agree with that, or do you think that that's a little bit too premature?
I think U.S. stocks, especially the big names, gives you a sense of comfort. There's a comfort in size. I think it really started during the pandemic. I also take into account the money supply, the erratic money supply. And I was reading something from mid-1990s, the bygone era, Chairman Greenspan talking about the money supply and how that really propelled the stock market. And then a year later, he talked about rational exuberance, right? So my concern on the US stocks, especially the big names, Lisa, is that we are really making a lot of money is flowing into these names, especially given the passive nature of the markets that we're living in. And it remains to be seen at 35 times the PE on the Max 6, how much more comfort one can get. You know, what we are telling our clients is that a better entry point might be coming your way this year. So rather than, you know, for new money to stay put and not really start investing.
Just to be very clear, you kicked Tesla out. Is that why it's the Mag 6?
Max 7, sorry.
Oh,
yeah.
sorry. I just wanted to make sure. This is something we people talk about.
One of the financial companies replaced Tesla, right? Berkshire is the seventh
it's
one.
It's gone from 7, 6,
exactly.
5, 4.
Well, I'm just wondering, you know, exactly who it is. I know it's the Super 6 or whatever.
It raises the question, though. How much fragmentation are you seeing in the group of the big winners of last year?
Well, we started to see it already, right? The names that have done really well, who are doing a lot more buybacks, you know, have done really well this year. You know, and Meta being the cornerstone here. And then you see Tesla having some issues with regards to their ability to have the same light of profitability that they were using it. Now, I gave all this with the caveat that I'm not a fundamental analyst, so I want to reserve my views here. But I
should probably avoid this conversation entirely then.
Maybe that's a good idea.
Because it's not just Tesla, it's Apple as well. There are some names that are really, Lisa, starting to underperform versus, say, two names, which is Meta and NVIDIA.
Which raises this question of, is this the beginning of some sort of new cycle where people are really looking for share buybacks, they're looking for dividends, they're looking for a certain level of performance? When you're talking about waiting for another entry point, what do you wait in?
Yeah, so I think there are a few things. See, a lot of the technicals are really quite positive for the bull market, right? So you look at the all-time high, you look at the a year out from the last rate hike, markets tend to be up mid-teens. Presidential election year without any challenger, that tends to be very positive. So there are some positives. However, in an election year, you also have a pretty copybook sort of performance of the markets. The first quarter tends to be positive. And then you have somewhat of a sideways to a mild correction going into the last 100 years prior to the election, where the markets have a high degree of volatility and tends to go down. A lot depends on what the market's sensing from the election, and then you have a relief rally post the election, no matter who goes into the White House. So I think you might get a much better entry point during the course of the year, maybe in the midsummer time frame than what you're seeing right now.
Is the election really something you can trade around, given the fact that we're looking at the longest general election in history?
Not necessarily, and we would advocate that your portfolio should be built to outlast one particular election cycle. Having said that, if you were to just ask me if this is the time today to start buying into the big tech, my suggestion would be no. Better entry points won't be coming.
Yeah. Does it feel like the longest ever because it's just a repeat of the last one? So it's like it never ended.
It just continued.
Just never ended.
Yeah, a long time.
Like 6, 7 years of it.
Everyone's really happy.
Deepak, can we just finish on the cuts that we're seeing? Lisa went through Continental. I think we've seen it at UPS. Lisa, the other companies we've seen in the last week, can't list them off right now, but we've seen many.
Instagram, we've seen a whole host of places.
Snap as well over the last few years.
Not Instagram.
Operational efficiency is a phrase that we heard from Mike Wilson at Morgan Stanley. Is this the year of operational efficiency, and what does that mean for some of these companies?
Indeed, I think you're also hearing restructuring and layoffs as along with operational efficiencies. And I think in a sense, what the companies need to exhibit at this point, I think if last year was the AI, investments in there, which is still going to be a current theme this year, I think the market's looking for your profit margins. Are you able to protect your profit margins in an economy that's going to be slowing, in a consumer that's going to be slowing, and inflation, especially in the core side, might be stickier? So do you have the pricing power? Do you have the operational efficiencies to at least do well in these kind of a market environment, which is quite drastic or different than what we've seen in the last few years?
Deepak, it's good to see you. Thanks for dropping by. Thank you, sir. Deepak Puri there of Deutsche Bank International Private Bank. Just to recap that headline, Continental to cut 7,150 jobs, amounting to about 3.6% of its workforce. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Jeff Bezos has sold another $2 billion of Amazon shares.
after selling $2 billion last week. The sales accounted for 24 million shares and took place over just 4 trading days, according to the filings. The world's second richest man said he had plans to dispose as many as 50 million shares in the company he founded. Amazon is up 11% in this year. House Republicans voted by the narrowest possible margin to impeach Homeland Security Secretary, that's Alejandro Mayorkas. An attempt last week to impeach the secretary failed after a deadlock. A lawmaker returned from cancer treatment to reverse the embarrassing defeat. Mayorkas becomes the second cabinet member in U.S. history to be impeached, but the effort is likely to die in the Senate, where a 2/3 majority is needed to remove him from office. Trump will likely drain his war chest for legal fees this summer. It leaves the GOP frontrunner crunched for cash ahead of November's poll. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July, just as the RNC triggers the official start to the election campaign. It forces the frontrunner to tap the party or donors for more cash. That's your Bloomberg Brief. John.
Danny, thank you. Coming up on the program, up next, Biden blasting Trump's un-American NATO comments.
No other president in our history has ever bowed down to a Russian dictator. Let me say this as clearly as I can. I never will. For God's sake, it's dumb, it's shameful, it's dangerous, it's un-American.
That conversation, up next.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Live from New York City this morning. Good morning. Counting you down to the opening bout in the next hour. Equity futures bouncing here by 0.5%. We're doing okay. Yields are lower by a basis point or two. 429.86. Under surveillance this morning, Biden blasting Trump's un-American NATO comments.
Just a few days ago, Trump gave an invitation to Putin to invade some of our allies, NATO allies. Can you imagine? A former president of the United States saying that. The whole world heard it. The worst thing is he means it. No other president in our history has ever bowed down to a Russian dictator. Let me say this as clearly as I can. I never will. For God's sake, it's dumb, it's shameful, it's dangerous, it's un-American.
It's the latest today. NATO defence spending on the political chessboard for Biden and Trump. A record 18 out of 31 NATO countries expected to meet the alliance's defence spending goal this year. Secretary General Jens Stoltenberg telling reporters today European allies are spending more. However, some still have some way to go. Joining us now is Ed Mills, Washington policy analyst at Raymond James. Ed, let's talk about this topic and we can move on to the other issues taking place in Washington over the last 24 hours. Is NATO membership really on the ballot this year? It's not that straightforward, is it?
So, Jonathan, I think the thing that I would highlight, there's policy here, there's politics here. On the policy side, last December, the United States Congress added to the defense bill a provision that does not allow the President of the United States to unilaterally withdraw from NATO. He has to give a 180-day notice to Congress, and then Congress would have to vote for this. That's not going to happen. That is trying to future-proof kind of this NATO conversation from a potential re-election of Donald Trump here in November. Once Donald Trump made those comments, from a political perspective, the Biden administration has been on the ropes after Herr's report last week and questions about his age. So it allows them to pivot and try to go on the offensive, trying to change the conversation. I think that's why we're talking about this morning.
But for the Trump campaign, and we heard from Robert O'Brien, who said that Trump was just giving some tough love. But for the Trump campaign, how much is this a cleanup act when they're getting in buildings and rooms with donors and supporters that actually want to see the United States stand by their alliance?
Yeah, so I mean, what version are we on in terms of something that Trump has said, and then we're kind of having the quote-unquote cleanup act? There is kind of, that's the nature of who he is. That's the nature of the way in which he campaigns. Certainly for the Trump campaign, part of the way in which he's been getting this nomination so far is he hasn't done a lot of events. He hasn't said a lot of things. I think the way I look at this is I have felt that this election come November is most likely a rematch and most likely going to be very close because we're going to get a different set of headlines every day, every week, every month that we're debating. Does this move the needle one direction or in the other? The reality is that we're going to likely have two candidates with a majority of the country having a negative opinion, and the person who is able to win, those who don't like them, is probably going to be elected the president. We're going to be debating that between now and November.
Can we talk about the foreign aid bill? You have individuals like Senator Lindsey Graham coming out and saying he's a no until it becomes a loan, something that Trump was putting out there. How hard is it to get this package done when the Senate and the House are so divided and the Republican Party itself is so divided?
So there are very few bills that get 70 votes in the Senate that don't ultimately become law. Now, is it this package as itself, or is it something different? That's going to be debated. But now the pressure is on the speaker. And there is either going to be a discharge petition, other parliamentarian kind of maneuvers, pressure for this to get a vote. And if this had a vote, this would have a majority. It probably has that 2/3 majority to get it done on the suspension calendar, which is how they've been doing things recently. So the fact that kind of Republicans are going to have to defend President Trump on his NATO comments, that puts a little bit more pressure. And also, obviously, last night, Democrats got another vote. That's more pressure, and you just need a simple majority to get a discharge petition, and then you need another simple majority to pass this. So from a defense supplemental, that $95 billion that passed the Senate, it has momentum because it had 70 votes and because how close the House is.
But barring a discharge petition, which right now people say is really fantasy land, if Speaker Johnson were to put this on the floor, would that mean him losing his job?
Yeah, we have said that if Johnson were to put it on as is, he'd be former Speaker Johnson. We have been talking to folks about other opportunities outside of this discharge petition and how you can get this done. We won't go into some of those arcane details. It's like defeating the previous question on a rule. However, this is something that a majority of the House members want to see. And you've even seen some House Freedom Caucus members admit if this were to get a vote, it would pass. So it's more about Johnson not having his fingerprints tied to something that ultimately gets signed into law.
So between now and potentially a government shutdown in March, what do you think actually gets done out of this Congress?
So the Senate's on recess this week and next week. The House is on recess next week. And so we have 3 days of session before March 1st. That's not a lot of time. So, do we get another push to have a short-term CR to get it from March 1st to March 8th? That's possible. Do we have a short-term shutdown? Does the State of the Union address on March 7th get delayed? That's possible. What we always tell folks here at Raymond James is that if there are kind of market volatility kind of tied to this, that disregard that, because the market's always up after that. And actually, during shutdowns since the 90s, since the Newt Gingrich, Bill Clinton era, markets on average are up during shutdowns. So the overall picture from DC is that there's a lot of fiscal support for this economy. And when you add in that $95 billion supplemental for defense, you add in the tax bill, which is still out there and still has a very good shot of getting passed as well. The spigot's on in DC. The support from a fiscal side is absolutely still there.
Do you see any of these fiscal potential bills, like the foreign aid, being attached to those appropriations, or do they have to go as standalones?
No, I think it gets a little bit more complicated when you attach it. What you've seen in the House is a pushback against the agreement that Speaker Johnson made on top line. Top line, we're going to do year over year flat on domestic, 3% or about $30 billion increase on defense spending. If you add to that number, you're going to have a package that year over year saw an increase when Republicans promised a decrease. That's politically very difficult. But we've also seen from Speaker Johnson a willingness to do things he said he was not going to do. And at the end of the day, you need to have a functioning government, even if it looks really dysfunctional through the process and that sausage making. So I'm not too hung up on if it's kind of one bill, 3 bills, but the most likely scenario, which is positive for the market, is that the majority of this, if not all of this, gets done. I've been on that grand bargain or bust train here for a while, and we're looking closer to that grand bargain at this point.
Interesting. Ed, it's so nice to try and talk about policy and less about politics. Ed Mills, thank you, sir, of Raymond James.
Thank you, John.
It's getting harder and harder to draw a distinction, though, between the two. You can see it in the polls that increasingly the Republican Party is becoming increasingly isolationist, which is what ultimately the former president is trying to speak to with offhand comments about NATO. At the same time, you want to take it seriously because the prospect that it may or may not happen in the future, I think it's really, really important. But then when you try and draw that divide between politics and policy, if you wanted to make that policy based on what's happened in this country over the last few months, it's going to be difficult to do that.
Well, right now, it sort of speaks to exactly that point, this idea of the deficit and how people are concerned about that at a time where everyone's talking about increasing spending. We just heard him say the spigots are on in Washington, D.C.
Yeah.
And this is part of the reason why people think that the U.S. economy can keep chugging along, maybe with a little bit more inflation to boot.
Soft landing, what soft landing? City's Andrew Hollenhorst with a note out just a second ago. Not a soft landing. The U.S. economy has entered a new regime where inflation is more elevated and more volatile. This has led to the FOMC keeping policy rates higher for longer, increasing the likelihood of a recession. Coming up next on this program, investors pulling back rate cut bets following hotter than expected inflation data. That conversation up next.
I'm relieved that at the very least the situation between China and the U.S. Is calming down, and at this stage we just don't need something else coming for sure.
Are you confident actually that the U.S.-China relationship will get better?
No, I'm not confident because I'm not in control of that. But what I know is that the world cannot afford an escalation, and most likely both countries cannot really afford some things to escalate in terms of economic consequences. I mean, the situation in both countries is fragile, and you know, I guess a geopolitical escalation is not going to be in the interest of both countries.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
60 minutes and a few seconds away from the opening bell in New York City this morning. Good morning to you. Equities are bouncing back from yesterday's losses. We were down 4% at the close on a Russell. We're positive by more than 1% now on the S&P 500, negative close to 1.4%. Losses were worse than that. We chipped away at them going into the close yesterday. We're positive by 0.4% on the S&P at the moment. If you switch up the board and get to the bond market, 2-year, 10-year, 30-year, 2-year 460, 74. Yield to lower by, let's call it 5 basis points. On the 10-year, still in and around 430. Remember all the calls that when we go higher, we want to buy that. Lots of people want to buy that. And then yields keep going higher. We've moved 40 basis points, Lisa, year to date on the 10-year. Is that enough to say, yeah, didn't you say you were going to buy that? Aren't you buying that?
Well, it raises this question. Are we there yet in terms of fully pricing in how long the Fed's going to be higher for longer? You referenced this note from Citigroup's Andrew Hollenhorst.
Yeah.
I think it's fascinating, basically saying that this is not an aberration, what we got from that CPI report. This is the new reality of a more inflationary world, and I keep wondering whether we've actually priced that in, or if people are kind of flirting with it. They're kind of wondering whether they can kind of commit to that, or if it's just sort of, you know, a trading.
It speaks to the difficulty of sort of calibrating policy to ensure that you get a soft landing is tremendously difficult given the volatility that Andrew's talking about and the continued strength in the US economy still today, after been talking about this for 12 months, maybe longer?
You know, I wonder if when we write the history books, I'm looking forward to that, reading someone actually explain what's going on, because it feels kind of like we're in a mess.
When they join the dots for us.
Exactly.
Yeah.
I'm looking forward to reading someone painting by numbers, because I like the numbers. But how much the fiscal side of it really is playing into this. How much we're going to say, you know, essentially, we're doing helicopter money. We've done that, and that's what we're seeing on the flip side of it. That, to me, is really going to be one of the key questions, and where we end up in a prolonged period of time.
I remember years ago, Joe Weisenthal talking about hindsight capital. Hindsight capital is super, super easy, right? And when they write that book, we'll be able to say it was not easy when it was happening. Like, you make it sound really coherent now, but back then, there was nothing coherent about any of it.
You can tell the story that you want to with the data in terms of which you should pay attention to and which you should ignore, which is the reason why what we're talking about with markets right now is pricing out a range of potential outcomes that are completely opposite to one another. And this is what people are debating right now.
Retail sales tomorrow, that's another number to look for. We are looking for a negative print there. 0.2% is the estimate in our survey. Jobless claims as well, worth a look. 220, that's the number we'll be talking about tomorrow. 220 is the estimate against the previous read of 218. Final snapshot of foreign exchange for you with a little look at dollar yen. Worth a little look, because yesterday we had more than a little move. A move of 1 percentage point on dollar yen against the Japanese yen in the dollar's favor, north of 150. Still north of 150 now, 150.54. We're negative on that currency pair by 0.2%. That is just a minuscule, tiny piece of yen strength off the back of some jaw-boning from Japanese officials yesterday, threatening to do something about it.
Threatening, saying it's because of speculation, which is not helpful. And people said, okay, so when do you start to take action? Because right now they've been doing a lot of job jawboning. They haven't taken action. And I think maybe markets are kind of, they're kind of sick of being whipsawed by just simply rhetoric.
Without a doubt. Dollar yen right now, 150.55. As Lisa points out, we're waiting for the action, not the words. Under surveillance this morning, your top stories lifts blockbuster earnings report showing a year-over-year revenue increase, a jump in bookings, and an upbeat outlook. There was just one problem. A clerical error stating margins were set to grow by 500 basis points. 500. And not 50. The company's CFO issuing a correction on the earnings call, saying the press release was incorrect. Shares pairing gains after an initial 67% surge. The mistake overshadowing an otherwise solid quarter for Lyft as it tries to keep up with its main competitor, Uber. Coming up at 11 a.m., Bloomberg Technology will catch up with the Lyft CEO. And I imagine they've got some questions for dear David about what on earth was in that release yesterday.
Do they have a copy editor? I mean, seriously, who reads it over?
You'd have to imagine they did.
The CFO, at the end of the day, before it goes out, has to read this over,
That's what I want to know. It's just process.
Room of lawyers.
Let's just talk about what happened that day. You know, sit down.
What did Dan Eisenwedbush say to the team this morning? It was like an episode from SNL, except it was real.
He was saying it was like Airplane. I mean, this is sort of the level of incompetency that it suggests. How do you then build confidence that there's not incompetency of that nature elsewhere in operations?
If you were sure, I mean, I'd love to talk to someone who was sure and how they really feel about this. This is beyond a clerical error. This is not sort of a simple, 50 to 500. That's a huge, huge difference. And the amount of people that would have read through that to miss it. A friend of mine said it's one of those situations where you sort of see what you want to see and not what's actually there. That we all want to say, if you're working at the company, we want to be able to say margins are going up 500, but they're not. They're going up 50. That's just a completely different figure.
Well, do you think that, that there was some intention behind it?
I can't imply that. I can't imply that.
But it was convenient.
It was certainly convenient to squeeze out shorts. It's worked that way. We can talk about the consequences of it. Got no idea what the motives were at all, a mistake or otherwise.
Yeah, I assume that they're going to have to demonstrate how it was not intentional, but at the same time, it doesn't just represent complete humorous incompetency.
Yeah, it doesn't speak well of the broader management there. If you can make those kind of mistakes, we'll be talking about it a little bit later with the CEO. Let's turn to the politics. Democrats picking up a seat in the House as Tom Suozzi wins the vacant seat left by ousted Republican George Santos. Queens and Long Island voters propelling Suozzi, who previously held the seat, to victory over opponent Marzi Pillar. Suozzi winning 53.9% to 46.1% with 93% of the votes counted. The race seen nationally as a referendum on President Biden and immigration policy. The GOP currently holds 219 to 212 majority in the House. It gets slimmer and slimmer.
Well, this is what is so concerning if you're waking up and your speaker, Mike Johnson, your majority is getting whittled down day by day. And when you want to put partisan bills through Congress, it's going to be very challenging, and every member has to show up for those votes. To say that it's a referendum on Biden, I find interesting because Tom Suozzi is also a different candidate. He held this district. He knows these constituents. I think there's a little bit more to say about not so much that she wasn't a quality candidate, but name recognition ID.
I think the nature of the race is going to be interesting as well. If you think about the races getting closer and closer to the election, around the election for the national campaign, will it actually be a referendum on Biden, or will the Democrats, these candidates, actually put distance, some daylight between themselves and the president?
Well, that's what Tom Suozzi did. That's what the Connecticut governor did when he was sitting around this table saying Biden should be closing down the border. You're seeing Democrats from blue cities point the finger at the President Biden to do more when it comes to the border because it's now impacting them and their constituents.
Less politics, more price action. You're tuning in for that, I'm sure. Yields are lower at the front end of the curve, down 5 basis points on a 2-year, 460. Traders over the last day or so adjusting their rate cut forecast after CPI came in hotter than expected. Global bonds have now erased all the gains they made since Fed Chair Jay Powell's December pivot. Fed reaction coming a little bit later. Goolsby, Barr, Waller, Bostic, Daly, all coming out to round out the week, reacting to that data. Let's catch up with Bloomberg's Ira Jersey to talk a little bit more about this. Ira joins us right now. Ira, did anything change for you with that print yesterday morning?
Well, it didn't change anything for us because we had thought that inflation was going to come down much slower than what consensus was pricing. We've been talking about the idea that that Treasury tips break even, so the break-even inflation rate that the market was pricing, as well as the number of cuts that were being priced for this year was unrealistically low. So we were talking about having five or six interest rate cuts this year by the Fed. Our call has been 3 for the whole year. And I think this just solidifies that idea that maybe they hike once before mid-year, and then they we really wait to see what the data is in the second half of the year before the Fed can actually cut much more.
Ira, can we talk about the data a little bit more? We had a conversation with Sarah Wolf of Morgan Stanley early this morning, and she was talking about the gap between CPI and PCE. How big is that gap at the moment, and what explains it?
Yeah, well, it's growing. It has grown, and we'll see, obviously, on Friday what the PPI data comes in. Yeah, the interesting thing about CPI, PPI, particularly in the core measure, that tends to have a pretty good relationship with things like corporate earnings, right? So that's one of the reasons, perhaps, why it shows that businesses still have some pricing power, even though a lot of the inflation that we're seeing is in the service sector. So if you look at services wages and where the inflation was yesterday, it was almost all in services, and that means that if you can grow your, as long as you can keep your price increases more than what you're paying employees and wages, you're likely to see, decent uptick in earnings from an economic perspective. I think importantly, you mentioned, John, at the top of the half hour about tomorrow's retail sales report. I think that's going to be key, because if we get the retail sales control group coming in above the 0.2% that's expected, I think that'll be a big sign that the recovery or the continued expansion that we're having is still on track.
And what sells off more, the front end or the long end?
Probably the front end. I think if you get something like a 0.4, 0.5 on the control group tomorrow, you can wind up, pricing out yet another interest rate cut that we have for this year. So if we get the 3 cuts that the Fed dots, ourselves, and even Governor Waller mentioned a couple of weeks ago, you can wind up with 2-year yields at around 4.75%. So another 15 basis points or so higher from where they are right now. Now the whole curve will probably go up, but I think the front end still takes a brunt of it. Just because the Fed's going to be on hold for a little bit longer than the market was anticipating.
The reason why I ask, and John was talking about this note from Angie Hollenhorst and Veronica Clark over at Citigroup just moments ago, where he said, stronger 0.4% month-over-month core CPI is not an aberration. The U.S. economy has entered a new regime where inflation is more elevated and more volatile. Higher for longer is definitely going to be the case. Do you agree with that assessment, Ira? Is this sort of a stickier inflation where this rate isn't as restrictive by the Fed as many people think?
Well, I think that's very possible, and that was certainly the discussion point that I was having with a lot of investors yesterday. In fact, there is a camp out there that believes that the Federal Reserve should probably be increasing interest rates even more. I think that that's pretty unlikely that the Federal Reserve is going to start hiking, because the first thing that we need to do, and I think that the Federal Reserve has to acknowledge, is that they have to jawbone out a lot of the cuts that are being priced, not only for this year, but also for 2025. And quite frankly, pricing out those cuts is as good as them hiking, because the fact that you have this inverted yield curve and the expectation that they're going to cut interest rates quite substantially over the next 18 months is easing financial conditions quite a lot. And I think that's something that the Fed has to acknowledge a little more forcefully. And I suspect in some of the discussions and some of the speeches that we'll have over the next couple of weeks that they will actually be saying, like, look, we might not cut at all if inflation continues to run at over 3%, which I think will have pretty significant implications for, particularly that front end of the curve that we just talked about, where you can see yields continue to move somewhat higher.
Russ Kostrich earlier this morning from BlackRock was talking about how he doesn't really like bonds all that much based on the fact that there's supply and there are concerns about inflation and all of this. And I'm wondering whether we're going to start worrying about auctions again now that yields are a little bit higher. Is this going to be sort of a new focus where people now, once again, worry about the deficit?
Yeah, I think so. You know, it's the auctions have been odd, right? Because the January auctions didn't go very well, but the refunding auctions that we had just last week, they all went very well. You know, the 10-year and the 30-year in particular did much better than we had anticipated. You know, we had thought that they would be a little bit choppier, but demand by end users was good. I suspect that there will be some bottom picking and some folks who you know are say short the market, where if you look at some of those auctions, and also maybe some people just, you know, adding a little bit of duration as yields get higher, particularly if we get up to around 4.4%. So that's the next really important technical level on the 10-year. That's a 50% Fibonacci retracement, and that's going to be my focus. Above 440, and I think you can actually extend the sell-off much more, but that 440 level, I think we'll start to see some buying.
The market moving closer to you and this Federal Reserve. Ira, thank you, sir. Ira Jersey of Bloomberg Intelligence. These traders on Wall Street are such a romantic bunch. New rhyme for you, little poem. Roses are red, violets are blue, inflation is sticky, we're nowhere near two. That comes from Kevin Higgs out on Twitter. That's better than the ECB's.
It's direct response to the ECB.
Isn't it nice? I think that's great.
Oh, is that your Valentine's
Happy
wish
Valentine's
to everybody?
Day, Wall Street, without a doubt. That's our wish, isn't
touching.
it? Get back to 2%. Just a beautiful thing. On a bed of roses.
Do you celebrate?
Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief. And Danny Berger. Hey, Danny.
Hey, John. Donald Trump will likely drain his war chest for legal fees this summer, leaving the GOP frontrunner crunch for cash ahead of November's poll. Trump spent more than $51 million in 2023 on legal expenses and can tap another $26 million from an allied super PAC to pay his lawyers. But as his 4 criminal cases ramp up, those funds are expected to dry up around July. That's just as the RNC triggers the official start to the election campaign. It also forces the frontrunner to tap the party or donors for more cash. Jeff Bezos has sold another $2 billion of Amazon shares. That's after he already spent $2 billion last week selling the stock. Regulatory filings show the sales account for 24 million shares, and they took place just over 4 trading days. The world's second richest man has said he plans to sell as many as 50 million shares in the company he founded. Shares of Amazon are up 11% so far this year. Shares in Airbnb are lower in the early trade. The company reported strong fourth quarter results, but suggested early 24 demand is waiting. Earnings from the company initially came in strong on the back of continued post-pandemic travel demand, but Airbnb expects the number of nights and experiences booked will likely moderate this quarter as demand normalizes. That's your Bloomberg brief. John.
Danny, thank you. Appreciate the update. Up next on the program, Alphabet's $100 billion cash pile.
We're continuing to invest in the business. There's a lot of extraordinary upside in the business. And then we do make investments and acquisitions, so do all of our peers.
More on that conversation coming up next. Counting you down to the opening bell, 45 minutes away. Equity futures near session highs, positive here by 0.6%. Live from New York, this is Bloomberg.
How are you feeling right now about the state of the industry and what it's going to look like in the next couple of years?
The big picture is it has never been more, I would say, volatile. I mean, it has, but you know, it continues to be volatile. But like you said, we did see real signs of life this summer. So generally speaking, box office is down globally around 20% to 2019, so pre-pandemic levels. But this summer, it was 5% down. Right, so it would suggest that even though there were winners and losers of this summer, and obviously we had the 2 big juggernauts with Barbie and Oppenheimer, you know, movie-going begets movie-going, right? So when there's a season filled with, you know, good movies that people want to see, you know, I was made to feel pretty optimistic about what we saw in the summer.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities.
Good face bigger challenge. Britain's next.
Was going to keep rain World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Live from New York City this morning. Good morning. 9:30 Eastern Time. Your opening bell about 42 minutes away or so. 8:47 Eastern Time right now. Equity futures at the moment positive 0.5%, bouncing back from yesterday's losses. Yields were up big time yesterday off the back of that hotter than expected CPI report. They're down a touch this morning by not even a basis point on a 10-year. 430.84. Under surveillance this morning, Alphabet's $100 billion cash pile.
We're continuing to invest in the business. There's a lot of extraordinary upside in the business. And then we do make investments and acquisitions, so do all of our peers. There's a lot that's exciting going on in the world. And so we're looking across the board. Starts within the business, then it goes to investments and acquisitions, then obviously return of capital through a not inconsequential share repurchase program.
You can watch the full conversation with Alphabet President Ruth Porat tonight on the David Rubenstein Show. Peer-to-peer conversations. I'm pleased to say that David's catching up with us to talk about that chat right now. David, good morning to you.
Good morning. Thank you for having me.
Great to catch up with you. Ruth Porat's storied career, not just on the West Coast and Silicon Valley, but also on Wall Street, and has faced existential crises in the past with Morgan Stanley right at the epicenter of the financial crisis. I'm wondering from your conversation, did you get the sense that Alphabet feels like they're facing one of those right now?
No, I mean, she's lived through the crisis of 07, 08 with Morgan Stanley, where Morgan Stanley came very close to having to file for bankruptcy, and they obviously survived. As the CFO, she did a great job there and was recruited away to be the CFO of now Alphabet, then Google. And now she's been promoted to be the President and Chief Investment Officer. So she's got the highest job she could probably get as a non-engineer at that company. And she's got a more than $100 billion cash pile to invest. So she's very popular with Wall Street people, for sure.
It feels like that AI is the threat, potentially the existential threat to the core business of Alphabet. Did she say much about that, David?
We did talk about it. I wouldn't say she thinks it's a threat. She would say it's an opportunity, because while Microsoft has gotten a lot of attention and obviously very strong in AI, Google has a lot of AI capabilities as well. And when they start putting that on their platform, I suspect it will really enhance the use of Google.
I want to talk about share repurchases. This morning, Uber announced a $7 billion inaugural share repurchase. We've seen incredible amounts of share repurchases and dividends, Meta with their new dividend. Is this the new playbook, that essentially it's not about pie in the sky and it's not about the metaverse and it's not about that? It's just cold, hard cash?
Well, it's hard to make a lot of acquisitions these days with cash because the Justice Department, the FTC, don't seem to be approving very many things of any consequence, so that's a factor. Secondly, these companies are making a lot of cash, and there's no doubt that while there's a tax on share repurchases, it's a modest tax, relatively speaking. So people that want to do share repurchases are going to do them despite the 1% tax that occurs now. So I think if you've got a lot of cash, giving it back to your shareholders is good. It's hard to make acquisitions of size these days without having regulatory problems.
So is that the reason why you think you're going to see this a whole lot more?
I suspect you'll see more of it for the time being. Now, if you have a lot of cash, regulators sometimes don't like you to do share buybacks, and that's why the Congress imposed a tax, but they don't like you to make acquisitions either. So it's, it's a difficult situation.
Do you expect the cash to be deployed into sports teams more frequently?
I suspect probably not.
That's exactly the question I was going to ask.
I think individuals, to be honest, publicly traded companies don't yet typically buy sports teams, at least in the United States. They do overseas. So it's mostly wealthy entrepreneurs or other people who have the cash to do that. And I suspect you'll see more of it because the values of sports teams has risen dramatically in the last couple of years. When the New York Yankees were bought by George Steinbrenner, I think it was in the 1970s, he paid roughly, I think, $8 million for the team.
That's amazing.
$8 million. When the Baltimore Orioles were brought to Baltimore in 1954, they were paid, the purchase price was $2.2 million. $2.2 million. So these teams tend to go up in value. They don't tend to go down.
There is a feeling here that maybe we've reached a saturation point with the competition for sports TV rights, and that potentially we might have reached the limit for how much a franchise is worth. Would you push back against that in some way?
Well, people always say this is the highest price anyone will ever pay for anything, and the world keeps going on because we have inflation and so forth. Clearly, there's only a limited number of people that can watch a game, or how many people you have on the face of the earth. Everybody can't watch every game, and even so, these prices have gone up. So, for example, take the most recent Super Bowl game. More people apparently watched that than watched any television event since the moon landing in 1969. So there are a lot of people out there who like to watch sports. There's nothing wrong with it. And,
do they like American football, or do they like sports? Because American football has absolutely dominated TV ratings. What can baseball do to get there?
Well, there are two different types of things. More people go to Major League Baseball games every year to go to NFL football games. Obviously, the more games, but you have a lot of people showing up at the games. And the TV rights, though, there's no doubt that NFL dominates television. If the top 50 shows on television history in the United States, probably 40 of them, or 45 or so, are NFL games of one type or another. It's just unbelievable.
If someone's tuning in and they don't know why we're talking about this, it's because you have invested in the Baltimore Orioles, almost $2 billion.
I thought we were dancing around that.
Yeah,
Lisa.
well, I'm just going to go directly at it. I mean, what is this? This is ridiculous. But I want to ask you, why? Is it a sort of nostalgia play? Is it because of the investment for the valuation?
A couple of things. First, I am from Baltimore, and I grew up rooting for the Baltimore Orioles. And I should point out that the league has not approved me yet. I have to be approved by the ownership committee. So a deal has been announced between the current owner and a group that I put together, but it's not technically approved. Hopefully, it'll be approved at some point in the not too distant future. But for the time being, I would say I'm interested in it because I want to give back to my hometown. I enjoy. I would say I'm interested in it because I want to give back to my hometown. I enjoy sports. I think it's a very good investment opportunity, so for all those reasons.
What's the courtship like? Do you have to go to them and explain kind of what you would do, or do you have to kind of give them a sense of your commitment to Baltimore? I'm just curious about the process of this type of thing.
Well, they asked if I would go on surveillance and talk about it, and I said I would. So that was the main reason that they agreed to let me do it. I actually think that, you know, anybody that sells a sports franchise doesn't want to sell it to somebody who's going to ruin the franchise. So you have to say why you think you can make it even better than somebody's already had it, did with it. So I think we can do a good job with it, but we're going to bring back a lot of people that are well known in Baltimore. Cal Ripken is a good example. We'll be investing with us and other things. So I think we can assemble a good group of people who care about Baltimore. And one of those people who care about Baltimore is a guy named Mike Bloomberg.
Okay, I've heard of him.
I've heard of him too. I didn't know he was an Orioles supporter.
Mike is a graduate of Johns Hopkins, and I think has given more money to Johns Hopkins than any single individual in the history of our country has given to any other one university.
That is true.
So I think roughly $5 billion, I don't know exactly, but something like that. So he cares about Baltimore and is happy to participate in this as well.
But possibly the Red Sox a little bit more than maybe the Orioles. Maybe. I thought Boston sports was the thing for Mike.
Well,
I'm going to drop by the desk after this and make sure I'm not getting in trouble.
Mike is probably watching, but I think his main sport might be golf, but he does like baseball.
That is true as well. Can we just finish, just a final word?
Okay.
International investment in American sports. We've seen a lot of it go the other way. Are you expecting more international investment in American sports? Are we going to open the doors to the Saudis, for instance?
There's a certain xenophobia in the United States with certain parts of the world investing here. So I think if I think Saudi investors, Chinese investors, Russian investors would raise eyebrows, to be honest. So I think also the American sports tend not to be as global in that sense. So English Premier League is a global sport. American baseball, American football tends to be more of a American sport. Now, NBA basketball is becoming more global, but I think you're more likely to find American entrepreneurs buying these teams than global companies or firms.
Interesting.
Right now, only one NBA team has a sovereign wealth team, a sovereign wealth fund investing with it. Sovereign wealth funds have not been approved by the NFL or the Major League Baseball. So at some point, sovereign wealth funds will probably be investing, but right now they're generally not.
We got to go. David, thank you.
My pleasure. Thank you. what happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
And so I think what you're going to see in this environment is the appearance of a different and new equilibrium state. It's very scary because obviously investors value predictable, profitable growth. There is no predictable, there's hardly any profitable, and there's hardly any growth. And so how do you actually make decisions? You go revert to what you're used to. And I think that's going to be very interesting. In uncertainty, there is no signal. Uncertainty is about unknown probabilities. What you can do is resolve it, which is take some steps, do some experiments, and if it actually resolves and it turns out it's going here, then be the dominant player there. So I'll say those are all the ways in which we see in health, but also in the scientific world, uncertainty is an opportunity. Last thing I'll say is that in dramatically changing times, that's when new technologies have a slight crack to actually matter. E-commerce, certainly AI now, many the vaccines. So if you think about it, the technologies underlying the mRNA vaccines existed for 10 years. But the moment in which it actually became possible to do this at a global scale actually was as a result of crises. And the question is, what opportunities is the climate going to present? What opportunities are these current moments of massive shift going to present? And I think that's where entrepreneurs and innovators have to realize this is not the time to actually retreat. This may be a once-in-a-generation opportunity to have the ability to matter.
Timelessness and sustainability go together, right? You can't expect to be timeless if we're run out of resources. So for me, sustainability is not a side activity. It's not a reaction to external pressure. It's core to who we are, what we stand for. And to a very strong extent, it's about future-proofing our business, right? You need to focus on sustainability to recruit. More and more, that younger consumer we're talking about, they want to work for companies that care about this planet, that do more than just kind of generate revenue and profit. You need sustainability to attract consumers. More and more, including that younger consumer, they care deeply about what are you doing differently? How are you making a difference? Investors, particularly in Europe, more and more place value on what you're doing in sustainability. Many of our partners have expectations on sustainability.
From New York City, for our viewers worldwide, a very good morning. I'm Manus Cranny in for Jonathan Farrow. It's a battle for the renaissance of the equity bulls. We're just picking up 0.5%. Uber flies high on a $7 billion buyback. Countdown to the open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Show futures rebound after the worst inflation day decline since 2022. That hotter than expected CPI erasing the last remnants of a global bond rally. And whoops, fat finger, that error sending lift shares on a wild ride after the earnings. We begin with the big issue of the day. Were Fed rate cut hopes go to die?
I'm not sure who was expecting rate cuts to really take place in March at this point.
This is a bit of a bruising CPI report.
The number was a bit hot.
It's not good news.
There's a lot of things that the Fed is not going to like.
It does complicate the messaging and the decision-making for the Fed.
We now had to punt on rate cuts further into the year.
I think the first rate cut is in June.
Late this spring or in the summer.
I won't say that the June cut is off the table yet.
The Fed will not be cutting rates as much as the market expected.
We only have 3 rate cuts this year.
3, maybe 4 cuts.
They certainly don't seem to be in a rush, and they don't look like they need to be in a rush.
We still have a long data between now and May, and we'll see how the whole totality of the data pan out between now and then.
Well, joining me now about those dreams to discuss everything is SocGen's Subhadra Rajappa and Nuveen's Tony Rodriguez. Good to have you both with me. I love what UBS sent to my inbox this morning. It was hashtag hot, not hashtag hysteria, when it comes to the CPI. Tony, good morning. You co-chair the investment committee. Was it a stable conversation? This is one jolt, or was it a mild touch of hysteria on the spike yesterday in CPI? Good morning.
Good morning, Manos. Good to be with you. You know, it was definitely a piece of information that complicates the picture in terms of expectations for the Fed. So you saw the market price out a couple of cuts. If you look at PCE, 6-month annualized, still running at 1.9%, well within the Fed's expected, hoped for target range. CPI a bit hotter. So it does complicate the story for the Fed. From our perspective, as we're looking at the Fed, we're thinking about their ability to cut being driven by two things. One is the decline that we've seen in inflation that we expect will continue over the coming months. And number two would be any potential slowdown in growth. What's really changed over the last month in our minds is that the growth story is much stronger than people had expected coming into the year. So any kind of slowdown to a 1% growth pace in the second half of 24 seems far less likely. So the need for any cuts related to slow growth seem to be off the table. With respect to weaker inflation, there we think the number of cuts that might be required by the Fed is more in the neighborhood of 3 or 4, which is what the Fed, or what the market is now back to pricing in. Somewhere around 3 to 4 cuts starting around the middle of the year, whether that's June or July, and that's more consistent with what the data has been. So the inflation story, definitely at the margin, worse than it had been a month ago, but not materially different in our minds.
Well, it's certainly the market finally coming to the heel of the dots put out by the Fed. Subhadra, good morning. You would also remind us that we must not venerate or worship or rely upon 3-month and 6-month annualized inflation readings. You say too much store of value has been placed on those. So it's a healthy jolt.
Yeah, for sure. I mean, I think that this brings home the point that Chair Powell was trying to make in the 60 Minutes interview, which is that we should probably be not just looking at 3-month or 6-month annualized core PCE inflation, but also look at the 12-month or the year-over-year core PCE. And, as Tony was pointing out, and I'm very aligned with what he said, inflation is definitely on a steady trajectory towards disinflation. I wouldn't read too much into 1 month's inflation print, but really what has surprised us fundamentally is the strength in growth. I mean, the third quarter and the fourth quarter were extraordinarily strong on the growth front, and that momentum seems to be carrying into the first month of the year and perhaps into the first quarter, and that's really what's changing our view on what the Fed will deliver for cuts for this year. So I think the data is definitely relatively strong. The Fed is locked and loaded. If they need to cut rates, they will, but there's no urgency for them to act.
No, they certainly got the cover that they need now in a bond market that has been reawakened the bears, but perhaps not the vigilantes. Well, the rate cut expectations are in focus on that hotter than expected CPI print. Let's turn our attention to the slate of Fed speak this week. Bloomberg's Mike McKee is with me. Mike, I mean, it's a roster that could help validate the cover story on the back of the CPI. This is where they will have to say, we don't have the confidence to cut rates or not, because we will focus on the PC. Mike.
Well, it's really interesting, man. It's because after the CPI, you had a lot of analysts commenting. You showed them at the top of the show, but we haven't yet heard any Fed officials. We did hear this morning, just a short time ago, from a former Fed official, Eric Rosengren, who was the president of the Boston Fed, who had a very counterintuitive take on all this, saying the market overreacted to the CPI report. While above analysts' expectation, monetary policy is not set to analyst expectations. Nothing in the report indicates anything other than a continued trend toward lower inflation. A March cut was already off the table. This will have little impact on May. Kind of interesting. Here's what the market is looking at that has them thinking the Fed may be either backing off on cuts or pushing them out. This is the super core. Core services ex housing, the number that Jay Powell likes to look at. And if you look at the far far right there, you can see the big increase. We take out housing, and it certainly suggests there was a lot of inflation in the service sector that we hadn't seen in recent months. And you drill down into that using the Bloomberg ECAN function, and we can see that housing is still a problem. The thing about housing is that the rent numbers have been going down, but housing prices, as you can see again on the right, still going up at a relatively quick pace, and that also puts a lot of pressure on the CPI. So there is inflation, but there is also concern about what's going on with the rest of the economy. You look at the calendar for today, and you'll see that there is some Fed speak. We've got Goolsbee coming up in about 20 minutes. Michael Barr probably talking about bank regulation. That'll get a lot of interest on Wall Street, but not for policy reasons. And then tomorrow we have, my goodness, a very, very big day with all kinds of numbers that could impact the Fed, including retail sales. And then on Friday, PPI. That'll be interesting because we'll see some numbers going into PPI from the CPI and into the PCE report, which comes up at the end of the month, particularly for healthcare. So a lot to watch still, and maybe that's why Eric Rosengren is saying this isn't going to have a lot of impact on when the Fed cuts rates.
Okay, Mike, thank you very much. We'll be tuned in for that Fed speak over the next 24 hours. Subhadra Rajapal and Tony Rodriguez are my guests this morning. Subhadra, can I bring it back to you because John Arthurs has a lovely piece on the Bloomberg terminal this morning. Said, first, it was transitory. You will both remember that. We endured that for quite some time. It was never transitory. Now to intransigent. That's the risk, isn't it? When you look at the data that Mike has just put up in front of us on housing, on the owner's equivalent rent, it depends where you look in the country. Do you think we could be going into an intransigent period? The last mile is not going to be an easy one-way ticket ride, is it, Subhadra?
Absolutely, and I think that that's the point that the Fed has been emphasizing, and a lot of economists have as well, is that it's probably easier to get inflation, from very high levels last year, close to like 9%, down to maybe 2.5% to 3%, but getting it to 2% or below, or I should say, back to 2% is going to be a lot more challenging, given the fact that the labor market's extraordinarily strong. You're looking at wages that are high and sticky, and so far we've really not seen any sort of an indication that the labor market is cracking. So I think that last mile is definitely going to be very challenging. And also, I think what's interesting about the super core discussion that Mike was pointing out is that at least in CPI, the gains were very broad-based. But what the Fed really looks at is core PCE. And it's not clear that a lot of these components, especially things like shelter, are going to feed into a much hotter core PCE. So we'll be looking towards core PCE to see if that actually translates to higher prints over the next 3 months.
Well, Tony, let me take that to you. The risk is now very squarely in the camp. If we extrapolate what Subhadra has said and what other guests have said this morning, the risk is a hotter, slightly hotter, spiky PCE, core PCE. That could reignite the argument that you break the 425 level and you could retest the upper fours. Is that a material risk? Should I be positioning for that? Are you tempted by the bears, or are you sort of saying, look, man, it's 425, 450, I incrementally add duration here?
Yeah, thanks, Ash. I do think that our view has been that fair value for the 10-year around this time is somewhere in the 4% area. So as we get into the 4.25 to 4.5 range, we do think that's an attractive area to either begin to close out any duration short positions or begin to establish some longer duration positions, because we do not see a reacceleration in inflation. But I 100% agree with Subhadra that the last mile is going to be very difficult. Our view is that while core PCE has gotten down to 2.9 very quickly, we were at 4.2 back in July, our expectation for the end of the year is that we only see maybe another 20 to 30 basis point improvement in that level. So it's going to be well into late 2025 or 26 before there's any hope of the Fed achieving their 2% target in our mind. So definitely not transitory, definitely sticky, definitely a difficult last mile. But we don't see the reacceleration that would drive the 10-year back towards 5% where we hit, last fall.
Okay, well, it was worth a try to get you to break the range. So, Badru, you're not having any of it. You're 420, you're 375 bid, 425 offered. When you see movements like yesterday in the bond market, this is a very classic bond and equity market moment of overreaction. So for you, we still stay in the band 375, 425.
Yeah, that's our view. I agree with Tony. I think this is a very buy the dip environment in the bond market. If 10-year yields do get between 425 and 450, I think that'll be a buying opportunity. The real reason for that is because we're at the end of the cycle, and the Fed has clearly told us that the bias is towards lower yields. So, really, this is an opportunity for investors that missed out earlier on to get into long positions in bonds to kind of, buy the dip, if you will. So that's kind of what we're looking at. But broadly speaking, given the inflation dynamics and how strong the economy has been and how strong the employment picture has been, I think 10-year yields probably stay between 375 and 425, at least for the first half of the year.
Well, let's be fair. They don't need to telegraph cuts. I mean, it's not as if we're going to have a historically bad reaction. We'll have traveled and arrived probably when we get them, but they don't need to telegraph those. Tony, can I ask you then, we have this sort of no landing, soft landing scenario. We have perhaps much less rate cuts than we anticipated or we were aggressively pricing before Christmas. We've gone from 7 to 3. What does that do to the credit to bond scenario? Because you have a firm economy in theory, which shows to be robust. Do I lean more into credit then than I do into treasuries?
Miles, it's a good question. From our perspective, the real danger here is in the tail risk, that you either get a very, very hard landing, you end up with 10 or more cuts, or you get 0 cuts because inflation is reaccelerated. In that range of 3 cuts to 6 cuts, we think the outcomes are generally similar in terms of capital market returns. But the fact that the economy has shown more strength than had been expected, that is very supportive for credit. So we are very comfortable from a credit risk perspective in corporate credit, for example, emerging markets, in high yield leverage loans. But the higher for longer Fed, meaning fewer cuts this year than had been expected, that will eventually, we think, begin to really impact the lowest quality companies and borrowers. Think of the lowest quintile in terms of income for consumers. Think of the lowest credit quality companies. Think of the lowest quality segments of the real estate markets. Mm-hmm. Those higher financing costs are going to impact their ability to service that debt. So we're a little cautious about going into the deepest end of the credit risk pool, but we do think that kind of the higher quality segments of below investment grade and the broader investment grade credit markets are well positioned given the health of the economy as we look at over the next 6 to 12 months.
Okay. Thank you very much both for joining me. There are moments in these markets where you just sort of reflect on what Churchill said. You've never had it so good. Let's hope it turns out that way. Subhadra Rajapal and Tony Rodriguez, because we're positioned with an inch of our lives. Let's talk about the stocks ahead of the opening bell. What a belter from Airbnb. Abby, good morning.
Well, we will be taking a look at Airbnb, but first let's start off with the wild, wild ride of Lyft. So shares are up 20%, but that pales in comparison, of course, to the 67% higher yesterday in the after hours. Now, of course, there was this strong quarter, the outlook, but not quite as strong as the 500 bips margin improvement, that quote-unquote clerical error that had the stock at one point up nearly 70%. Instead, it's a 50 bip improvement. Again, though, strong quarter, 65 cents versus 7 cents. Inline revenues. There's a 14% short interest, so some of this could be a squeeze. Uber going along for the ride. Plus, they have unveiled a $7 billion buyback. Robinhood up 14%. Another short interest there, not quite as high, up 5%, but maybe a little squeeze. Revenue a bit better, so perhaps better than feared. Some analysts, though, saying that this quarter was solid. Investors seem to agree. And then finally, there's that Airbnb you were talking about, the odd stock out, down nearly 4%. They put up a mixed quarter. Analysts like it, but they're talking about the first quarter being a bit tough, that comps and the standpoint and Easter tough. $6 billion buyback. Brian Chesky, talking about reinventing the core outside of the core. But right now, investors want more.
Abby, thank you very much. Those bullish investors coming back to the S&P 500 will at last. We'll give you a lift in a moment. We're all revved up.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through.
Brilliant. An episode of Saturday Night Live. More on Lyft's massive mistake in just a moment. Unbelievable on Bloomberg.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
This was an episode of Saturday Night Live, except it was real. And I think that the scary thing here is just that it actually got through. And I think it's been really a comedy show that we've seen at Lyft for years right now. And this is, even though it was a good quarter, it overshadowed by another black eye moment for Lyft.
Brutal assessment by Dan Ives this morning on Bloomberg Brief from Wedbush, talking to us earlier today. And Lyft shares spiked after the ride-hailer said that margins were expected to jump by 500 basis points. However, the number was too good to be true, and the company corrected it to 50 bips an hour later on the call. Team coverage on this, Ed Ludlow in San Francisco. Alongside me here in New York, it is Mandeep Singh. Ed Ludlow, good morning to you. The highest annual ridership ever, but that headline got subsumed by this error. Was it a Saturday Night Live brutal attack?
Yeah, I mean, it was a wild ride, and the tail of the tape is simply that the deck or the shareholder letter stated margins would expand by 500 basis points incorrectly. Erin Brewer, the CFO, goes on the earnings call and says 50 basis points. An analyst calls them out on it and says, what's going on? And they acknowledge that it's a clerical error, that the press release was incorrect. But what's astonishing about it is if you look at the pre-market gains, and Dan Ives pointed to this, it was a strong quarter. Ridership in the quarter gone was slightly below, but the gross bookings outlook for this quarter is strong, you know, even at the low end of the range, kind of meeting consensus. And so Lyft still demonstrated that in the wake of the post-pandemic era, rider growth is there, and they're being competitive just against a bigger peer in Uber that has a much more diversified business. I can't get over the pre-market gains because it's just a weird situation.
It is, but I suppose when, you know, maybe now is the day that we have 24 hours to reflect and we look a little bit deeper into what is the business. Although Wedbush Securities were scathing in the least about what went before. Mandeep, good morning to you. So here we are. I'm an investor. I'm long of this stock, and suddenly I'm 65% in the money, and it's visceral. It turns around. I traded on this information pre-market. What is my retribution?
Well, so in this case, you have to put it in context. I think it wasn't intentional to begin with, and they fixed the mistake pretty quickly on the call. So look, the management team is new, both the CEO and the CFO, and it does hurt credibility, I would say, you know, given it was in the press release. And Lyft does have a history of, you know, surprising investors about their margins. So if you go back in time, their gross margins actually collapsed a couple of years back from mid 50% to mid 30%, and that happened because of insurance reserves. So it's a little surprising that, you know, it happened in the press release, but at the end of the day, you know, it was a mistake, and I think investors will move over it.
Yeah, everybody can make mistakes. It's still interesting, as Ed says. Gentlemen, thank you very much for joining me. Taking that story apart, you've got Lyft up 23% pre-market, and also Uber. Uber is up for different reasons. It's up 7.6%. You have got, of course, a share buyback there of $7 billion. So that's sort of driving that one. Gentlemen, thank you very much. And be sure to stay tuned to Bloomberg, because we have the Lyft CEO, David Risher, joining at 11 a.m. Eastern time. Perhaps he can respond to some of the heady calls against the delivery yesterday. Coming up, your morning calls. Clear Harbour's Aaron Cannon joins me. His outlook on the markets. Traders are continuing to push out their rate cut expectations. The bond bears have been reawakened, and we are down to 3 rate cuts in 2024. Good morning from New York.
Arguably the world's most successful risk manager. You have to be the world's most successful risk manager to run the world's most successful hedge fund. Do you manage geopolitical risk?
Well, I wish that statement were actually true.
I hate it when he attacks the premise of my question.
All right, and one of the things that we spend a lot of time on is to try to be a great risk manager, but there is a real art to risk management. And unfortunately, it's not until you have the benefit of hindsight that you actually know how well you were as a risk manager, all right? So just first and foremost, everybody who's in the business of managing money, we're all learning to be better risk managers, but you can't take that for granted. You don't, that's not like a God-given right. Just because you've made money, you're a good risk manager.
Obviously, all the buyers of the dip turned up today. From the breadth of the Russell 2000 up 1.4% to the NASDAQ trying to claw its way back. You've got Uber and Lyft up pre-market. One is a buyback story. So again, yesterday's price action on the downside, as we saw yields spike to the upside, perhaps was just a temporary interruption in the risk narrative for equity. These are your morning calls on what the analysts are saying on Wall Street. Moffett-Nathanson upgrading Lyft to neutral after their earnings. The earnings pointing to better than expected cost discipline. Up next, HSBC upgrades Hewlett-Packard to a buy, expecting better margins and a strengthening PC demand. And finally, Piper Sandler upgrades Citigroup to overweight, seeing an attractive buying opportunity following the recent declines. A real belief in Jane Fraser's turnaround story. Coming up with me, Clear Harbour's Aaron Cannon joins me for the implications on that hotter-than-expected CPI, the conversation on whether it was a one-off blip, and really if the Fed will focus squarely on PCE, and we are perhaps overreacting. #hysteria to the hot CPI. Good morning from New York.
You formed a partnership with Penny Pritzker at some point to do parking, is that right?
Yeah, so when I was working at JLL, that we went through this real estate recession in the early 90s, and the senior people at the firm said, let's do a retrospective on all these different asset classes to see what happened, how we overpaid, why we ran into so much trouble, what really happened in the marketplace. And when I did that, I recognized, wow, there were a lot of reasons why I liked the parking assets better than I did office and retail and industrial. And so I started really doodling on the differences between those asset classes and came up with a rationale to start a business in the parking space. But I crossed paths with Penny Pritzker, who later became our Secretary of Commerce. And she liked the idea, and she and I went off on this adventure together and built a real estate operating company in the parking space.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally. We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is Bloomberg.
Bounce back in these equity markets this morning. The narrative from UBS is, yes, it was #hot, but #hysteria reaction in the bond market and the equity markets because those owner equivalent rents perhaps distorted it. So equities are opening on the upside, both in the S&P 500 and the NASDAQ. We have some breaking news headlines, the beginning of Fed speak across the terminal. Mike McKee joins me now to tell me what Goolsbee had to say. Mike, good morning.
Good morning, Manus. We've got some comments from Austin Goolsbee, the Chicago Fed president, that track what former Boston President Eric Rosengren said at the top of the hour when I brought that to you, that the Fed's policy is quite restrictive now and inflation can be a bit higher. But that doesn't mean it's still not on a track for 2%. Goolsbee goes on to say that he doesn't support waiting until inflation reaches 2%, which may be, for the CPI at least, which may be a hint to the markets that they overreacted yesterday. He doesn't believe the last mile of inflation is going to be the hardest, and he says that the same low inflation print every month would not be the kind of thing you would expect to see. So Austin Goolsbee is suggesting that they think inflation is still on a track. It wasn't a terrible number yesterday for CPI, and he points out that they follow the PCE, not the CPI, and PCE is much closer to 2%. Manus?
Yeah, and productivity has rebounded much faster, Mike, than he had expected. So again, this is all about guiding us as best they can. Perhaps our over-exuberance on yesterday's CPI, hot CPI number, we were perhaps a little bit, according to UBS, hysterical. We're just seeing two-year yields drop to 4.59. If you look at a one-day chart on that, she's going right the way down. Mike, thank you very much for breaking those headlines from Austin Goolsbee. Let's turn our attention back to the equity markets. Some stocks squarely in focus. Lyft shares rallying after their earnings, but still a far cry from the earlier gains in the mid-60s. That clerical error sent the stock higher by 67%. Abigail Doolittle is with me now. Now we focus on the headlines. Abby.
Well, 5,500. Who's counting, Manus? Well, apparently the investors who first read that press release that you just referenced, suggesting that they could see a 500 BIP or 5% huge margin expansion this year. Well, that's not the case. Shortly thereafter, on the earnings call, management cleared that up, that it's 50 bips, which is still respectable, but the stock quickly came down. Today, though, we have it up 29%, the best day soaring since November of 2020. It was a very solid quarter. Beyond that, some investors and analysts are saying that they have lost credibility on that, but they fixed it pretty quickly, at least in terms of saying what was what. Their earnings beat 65 cents versus 7 cents. Inline revenues, there is a 14% short interest, so some of this could be a squeeze, because they also talked about having the highest annual ridership that they've had. Now, Uber also up sharply, up 8%, the best day since May of last year. They announced a $7 billion buyback, the first ever. On the year, though, it's a little bit lopsided. Over the last year, I should say. It is Lyft, or excuse me, it is Uber that's up more than 100%, including today, and Lyft up closer to 30%. But after yesterday's good quarter, putting aside that error, Manus, maybe Lyft is going to start climbing more on Uber's trails.
Yep, and that's a heck of a move by Uber, isn't it, on that buyback. Abby, thank you very much. Tune in a little bit later on, the interview of the hour, 11 a.m. Eastern. We'll have David Risher on Bloomberg TV. Let's turn our attention to Airbnb. The company saying demand may not be as robust as last quarter. The CEO prepares for a pivot. Ed Ludlow tells me why. Airbnb, so are you a hotel man or an Airbnb, Ed?
I'm a mixed basket. I mean, Airbnb is interesting, and it speaks to the story, because right now, Airbnb is pretty one-dimensional. It does one thing. What the market is reacting to, down 3.9%, biggest drop, or on track for the biggest drop since mid-December, is this idea that Brian Chesky is trying to tell investors Airbnb is going to be something different in the future. You know, the integration of more third-party services. We're not really clear on what AI looks like in the Airbnb context. What's interesting is the guidance for this quarter is revenue of $2.03 to $2.07 billion. Even at the low end of that range, it's still exceeding what the street was looking for. Really strong quarter in the December quarter, but it's that even if the numbers are good for the March quarter, the narrative is what's worrying. They're saying that we won't see the same growth quarter on quarter, nor from a year ago, and it's a simple case of lapping tough comps. Because if you think about 1Q 2023, that was a real hotbed of travel, post-Omicron, corporate and leisure travel in key markets like North America, but also in continental Europe as well. So wow, the decline's really accelerating, down 4.8% now. This is where we're at. Slower growth, but also trying to tee up or tease this idea Airbnb will look different in the future, but we don't really know what that looks like.
Yeah, I mean, what role does AI have in your checking in, as you say, to a property? But let's see how that evolves, because that challenges all of our thinking. And thank you very much on Airbnb. The drop-off accelerates there. On a different story, Robinhood. Now, the revenue surpasses the estimates, with deposit growth outpacing last year. Isabel Lee has the latest there. Wow, up 12.5%. Isabel, good morning.
Good morning, Manus. It's up 12.5%, but earlier when it opened, it was up 16%. That's the most since August 2022. And results were strong all over the board. We have a surprise profit as well, driven by a higher interest income and also a rebound in trading. And analysts in general were very impressed. We have KeyBank and Piper Sandler lifting their price targets. We have revenue that top estimates jumping 24% year over year. And executives also said that deposit growth, to your point, is outpacing last year. In fact, CEO Vlad Tenev said that the growth that they've seen in the first half of the first quarter already outpaced the entire fourth quarter last year. He also touted their increasing market share and, of course, their efforts for their global expansion. Net deposits were $4.6 billion in the fourth quarter. Crypto revenue was $43 million. That also surpassed estimates. And as we know, we have spot Bitcoin ETFs that launched last month after a years-long crusade, almost a decade actually. And Robinhood was one of the first to immediately put those in their platform and made it available for their customers. And of course, the enthusiasm around those ETFs boosted the price of Bitcoin to a two-year high. It peaked to around 50,000 in the past 2 days. And as we know, declining interest can support growth, which is why Robinhood said that from a headwind, this will be a tailwind for them. And shares are still increasing, up 13%, Manus.
Okay, Isabel, thank you very much. Let's turn our attention to MGM, the casino company, eyeing some acquisitions in the online gambling space, as well as live dealing. Simone Foxman has the details. Simone, where are they going?
Yeah, man, it's live dealing. So this is folks sitting live in a place like Las Vegas, celebrities and the like, dealing to online customers. This has turned into a big business, billions of dollars for some of MGM's competitors. And now it looks like MGM may be very close to its own acquisitions. CEO Bill Hornbuckle talking about how the company is on the heels of a deal we've talked about and had a vision of broadcasting live games from Las Vegas to the rest of the world. So very much seems like they're in that space. Also talking about a sports betting tech company that they want to make an investment in. Hornbuckle said he's on his way to Brazil later this month to try and explore a JV there. But when you look at the shares today, they're down over 6.5%. And part of this is because what's happened to regional revenues. That really seems to be the focus, even though it's just about 20% of the company's revenue overall. And it did overall beat on a lot of its major metrics. Barclays calling some of its regional revenue well below consensus estimates. Net revenue was down 12% year on year. And so this standing in the way of progress that we saw in Las Vegas and in its MGM China unit. Very strong results there. But, you know, you heard Ed talking about the future for tourism and where we go from here. Maybe that overall sentiment is something that is weighing on MGM today as it reports some weak performance in this segment of its business, Manus.
Okay, Simone, thank you very much. Simone Foxman there with the very latest on MGM. My guest is Aaron Cannon of Clear Harbor Asset Management, and his view on risk is this: the dispersion in the Fed's dot plot relative to the market continues to tighten as recent employment data, coupled with slightly hotter than anticipated CPI, suggests excessively dovish posture is not warranted. Good morning, Aaron. Good to see you. So there's Goolsbee on the tape. He doesn't support waiting until the 2% level is hit for a cut. I mean, this is where the Fed must be saying to themselves that we've gone from 7 cuts in the market to 3 cuts in the market. Job done. We can breathe a bit of sigh of relief. We've got the cover that we needed. We were just a bit too dovish, weren't we?
I think so. We came into the year and Fed funds futures, Manus, we're calling for, to your point, 6 to 7 rate cuts. And after that employment number, January employment data, we started to move towards 5. March was off the table, and now March is clearly off the table, and it looks like there's only a 30% odds that we see any movement in the Fed funds rate in May, with the first cut more likely in June. And I think, you know, if you look at yesterday's CPI data point, we missed by 0.1% month over month on core and headline, and we lost a rate cut in the Fed funds futures contract. So sort of interesting, moving towards the Fed's data point. And I think what's important is the CPI ex shelter has really increased only at a 2% annualized rate over the last 6 months. And I think the Fed is focused on that, as well as the PCE data. As we know, it's an important metric to the Fed, and that's running at a 2% rate or so annualized basis.
Then the natural question would be, when you see the spike in yields that you've had, do you think that pop to 430 has that washed out, has that cleansed itself? Has the market cleansed itself, you think, with that reaction function that we saw yesterday, which was quite punchy on 2s and on 10s?
Yeah, I think we're probably at a point now where, extending a little bit in terms of duration in the market makes some sense. I mean, we saw credit spreads actually tighten yesterday as we saw a meltdown across the board in equities. And so, that message yesterday clearly was an inflation rate adjustment pricing rather than a growth concern embedded in the market. I mean, you just look at federal outlays, Manus. We're spending $6.5 trillion this year relative to like $4.3 trillion pre-COVID in 2019. So you have a significant amount of federal government dollars. It's an election year flowing into the system, increasing at a 40% rate relative to pre-pandemic levels. So the idea that growth is going to dramatically decelerate from here over the next couple of quarters, I think is questionable. And I think that 3 rate cut rather than 6 therefore makes a little more sense. And I think Goolsby's probably right. Of course, he's a voter and we're not. We're just observers.
We are just passers-by and commentators, and they all eventually fade. It's interesting that you talk about the tightening in credit spreads, the dissipation in the equity market, and the jolt in the bond market. And let's talk about credit. There's a lovely line in our stories this morning. The credit is the easier choice because of the economic momentum. Are you a buyer of credit relative to sovereign and equity?
So from an asset allocation and risk management perspective, we still believe that owning that sort of core treasury and U.S. mortgage-backed security component of the fixed income market is critical in the context of also being sort of long-term equity owners. Because if the economy were to trend lower, we believe equities would come under pressure due to earnings and multiple compression. Right. And I think treasuries and mortgages would probably outperform investment-grade credit and certainly outperform high-yield credit in that environment. And of course, we're very cognizant of the reality that credit spreads are historically at tight levels. But we do own investment grade. It's just in the context of that risk management that we really believe in the correlation of assets when the going gets tough in the economy.
It's not shaping up well for the old bond boys and girls, though, is it? I mean, Bloomberg Global Bond Index down 3.5% year to date. It's looking a little bit uncomfortable. I know that 1 month and 10 days data, 14 days data does not make a trend. Is there a level of discomfort at all, do you think, in this market? I mean, they're not exactly short these bonds, are they?
Well, what's interesting is, we're almost seeing the mirror image of what we saw last year, which is to say that long duration fixed income for most of the year, or even the belly of the curve, didn't perform well. It had a bit of a rally, of course, from October into year end last year, rather significant rally, and that sort of saved the year in some sense for the bond market. But short dated, treasury bills also, short dated high yield credit, it's up on the year. And that's because the economy's strong and the Fed hasn't moved rates. And so that was sort of the narrative for 3 quarters in 2023. It's also the narrative for the equity market, man. As we've seen, equities being driven year to date higher by these, very mega cap stocks where, the small cap Russell 2000 and frankly, the equal weighted S&P 500 is still in flat to negative territory, whereas the S&P is up by 4%. And so that was a trend that we saw last year. And that's a trend we're continuing to see this year. We'll have to see how that plays out.
What do you think of the growth scenario? Because you're a bit skeptical. You talk about restocking, inventory restocking as being one of the bulwarks, the pillars, whatever way you want to present that. Is that just healthy skepticism at the start of the year, given that everything's priced to perfection? Briefly.
Yeah, so everything does seem to be priced to perfection. We're trading at 21 times forward estimates on the S&P 500. And, you look at 2023, we came into the year, economists said 75% of economists on your Bloomberg terminal said we're not going to have a recession. So I think we need to be a little cautious. Any modest adjustment downward in the economic narrative can fundamentally, sort of alter things. And yes, I mean, the GDP data that we saw did indicate that there was some inventory restocking going on. And that could be the tale of 2 stories. If there's demand there for that restocking in the future, that's great. But if those things sit sit in inventory, and are in that demand side is not there to the extent that those buyers thought that we would see, then that could be problematic for the economy. So we think the risk is still that we do have an economic slowdown, and maybe a modest one in the back half of the year, perhaps third or fourth quarter.
All right, Aaron, let's see how it plays out. There's still massive tail risks out there between war, between the price of oil, the resurgence of inflation. I mean, there are a myriad of left and right tail risks that can come to the belly. Let's hope some of them don't. Aaron Cannon there with his very latest thoughts on the markets coming up. The Democrats picking up a seat in the House.
Send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Swazi's win, narrowing the GOP's already razor-thin majority. The conversation next with Amory Hordan.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Just looking at your portfolio of businesses, it is about resilience, it's about pressure, it's about women. Like, so how does that come together how does it manifest in the deals that you're doing now?
Yeah, it's one of the things that I became increasingly passionate about after I retired, was acknowledging the fact that focus and this performance mindset was a huge asset that I had gained and that I had worked on and perfected for over 20 years. And now working through brands and founders, I just recently announced a collaboration with the Amman Hotel Group where I bring in the best talents in sports recovery and performance mindset in retreats and offering it there to their clientele. Our first one is actually in Phuket in February. So working through what that means, I mean, if you see the stats of Fortune 500 female CEOs, 80% of those women have played sport competitively through their life journey. And all those skill sets that they've built, to me, they were part of this first chapter, right? But how do they now apply to everything else I'm doing? And I'm so curious and interested in how I can bring that to the audience now and make it more mainstream and accessible.
Top names in climate finance are on Bloomberg.
I can't tell whether you're optimistic or pessimistic about climate finance.
A lot of great stuff is happening, but is it enough? No, it's not enough.
I'm biased. I'm a huge investor in both fission and fusion, and hoping that it comes in time.
Transition is not going to be an event. It's a process.
But at the end of the day, it's the right thing for the planet, it's the right thing for the industry, and there is business opportunity.
So this whole campaign has been about how do we communicate to people that we can be better if we work together to try and solve the problems we face in our country. And that's the message. That's the message that resonated with the people in this campaign. Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Powerful message there from the Democratic representative of New York, Tom Suozzi. delivering a victory speech following his special election win. Well, the Democrats taking back a seat from the GOP following the ousting of George Santos, narrowing the Republicans' majority in the House to 219 to 213. Now, the election occurred on the same day that the House voted to impeach the Homeland Security Secretary, Mayorkas, over his handling of the situation at the border. Anne-Marie Hordern is our intrepid political reporter and anchor of surveillance. She joins me now. So, can I extrapolate this early in February a win for the Dems over the Republicans, or was it idiosyncratic to New York?
So there's two things you need to look at. One issue that I think is going to be a read across throughout the entire nation is going to be immigration. If that's weighing on issues in Long Island, which is a far cry from the southern border, this is obviously going to be weighing on not just those individuals that live in states that border
it's just going to go much further up the up the roster there, isn't it?
It's hitting blue Democratic states. That's for one thing. But Tom Suozzi, what he was able to do was say, even though I'm a Democrat, he was able to put distance between him and the White House, saying the president should be shutting down the border. I agree with him on that. And he also talked about his time when he was in Congress on how he bucked some of the trends of the Democratic Party when it came to immigration. So he didn't shy away from it, even though our polling shows 6 in 10 voters in swing states lay the blame for immigration at the president's hands. So there is a blueprint, if you will, for some Democrats and potentially some tough districts to run on immigration and not have to deal with all the blowback the Republicans are putting on the president.
Well, maybe this is where the amplification, I mean, who am I to talk about political strategy? I've never run for office, but I mean, it's a big yet. Mind you, can't run in this country, can I? President of Ireland is always up there.
You can't be president, sorry, man.
No, I know, not yet. Never. But we've got an impeachment. I mean, American politics is fascinating. We have an impeachment, of course, against Mayorkas. Talk me through that, and what does that signal?
Well, it's the second time they tried to impeach him. They didn't have the votes the first round, and which is why Tom Suozzi picking up New York 3 is so interesting, because if he was sworn in and was on the floor for that vote, the impeachment would have never went through. It went through on the slimmest majority absolutely possible on a second time around. You have to think of Speaker Johnson waking up this morning looking at his dwindling numbers of this majority he has. To get that impeachment through, Steve Scalise had to come back. He's getting treated for cancer, for blood cancer, had to come back to Congress to cast his vote to get that partisan impeachment bill through. That is what you're dealing with right now in the United States Congress. Very slim majority, and even slimmer this morning waking up in the House of Representatives for the Republicans.
Okay, well, it just shows you just how tenuous it is. Anne-Marie, thank you very much. Anne-Marie Hordern there on the politics in Capitol Hill and New York, Long Island. Haven't been yet. There's a journey. Now, for some, the sector price action this morning. Abigail Doolittle has that for me. Abby, what have you got?
Well, quite a contrast to yesterday's sell-off. Today, we have the S&P 500 up about 0.5%. Broad sector participation, industrials, all the way down to consumer discretionary, up somewhere between barely at all, up to about 0.9%. The one stock or one sector that is not higher, staples. As for a sector that's been soaring in recent days, the S&P Transportation Index up about 5%. And this has to do with Uber, because Uber right now up 9%, its best day since May. Lyft up more than 30%, its best day ever, not included in this index. But of course, Uber announced that buyback, really giving that transportation index a boost.
Yeah, a nice kicker there. Abigail, thank you very much. Abigail Doolittle with the sectors for you. I'll take you through what you need to watch for the rest of the day into tomorrow. It's a beautiful day in New York. The markets are in the green. What's not to love? 49.80.
Regional sports networks, There's a lot of, it's a business that seems to be collapsing. Leagues have sort of toyed around with, should we do something ourselves? Some teams are doing like local TV and streaming. How do you see that shaking out?
So I don't think I'm right on this, but my instincts keep telling me this is what's going to happen. Because if you remember the WWE, they launched their own network that had their own content and had their own pay-per-views. And it was kind of a smart, bold, ahead of its time move. And then they pivoted at the perfect time and they sold their content to, what was it? Peacock.
Yeah.
And that was really smart too, because they were able to leverage that number as high as possible. So they always zagged where the money was and when the opportunity was. I think the opportunity for the NBA with the local teams would be to own all that themselves.
Trading diary for you for the rest of the week. The Fed Vice Chair for Supervision, Michael Barr, speaks at 4 p.m. Eastern. Fed speak continues. Waller and Bostic into Thursday. Will they reinforce the Goolsbee narrative? Plus, we'll get retail sales and another round of jobless claims. Finally, Friday, San Francisco Fed President Mary Daly, and we get the PPI numbers. That was Countdown to the Open.
You're a famous photographer, you're a conservationist, you're an activist. How would you define yourself?
I think I'm just a human trying to figure out how to be a better steward of our little planet. I am a biochemical engineer by training. I studied marine biology, fisheries, aquaculture, and then I realized that the ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera, and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words, and then you put a few sentences together, and one day, you might be able to write poetry.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Joe Matthew and Keely Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power live around the world every weekday at 5 p.m. Eastern, only on Bloomberg Television. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern every weekday morning at 6 a.m. Eastern, only on Bloomberg. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, you're listening to Bloomberg Intelligence. Alex Steele and Paul Sweeney here with you. We're going to focus on companies, on stocks, on economic data. We're going to feature the analysts from Bloomberg Intelligence, where we've got about 400 analysts all around the world covering 2,000 companies, 130 industries. We're going to tap into their expertise throughout the day, including on Lyft and Uber. We got some earnings results out of there. We got some stock buybacks coming out. So it looks like those companies are actually maturing, as you would say. Plus, we're going to talk about what's happening in these markets. We have a little bit of a rebound today. S&P 500 up 0.6% off of that big sell-off yesterday on that hotter-than-expected inflation print. So we'll break that all down throughout the next 2 hours. But first, let's start with Mr. John Zucker on Bloomberg Business Flash.
All right, green on the screen. Stocks pushing higher this morning. You have 9 of the 11 major industry groups higher in the S&P 500. Lyft gaining after the ride-sharing company corrected its outlook for earnings margins in 2024. There was a typo initially that helped send the stock up as much as 67%. And Airbnb shares, they were declining after the home rental company reported its fourth quarter results. Meantime, Seema Shah at Principal Global Investors says, you know what, yesterday's stock sell-off was overdone. And, well,
overreacted a little bit in the same way that it overreacted last year when we saw some soft CPI prints that it started to price in very aggressive rate cuts. I think you're seeing the same thing come across here. And I suspect that over the next couple of weeks, even maybe just days, the market is just going to kind of walk back some of the moves that it made yesterday.
Dramatic pause there from SEMA. PNC Financial says it's going to spend about $1 billion to open new branches and renovate existing ones. S&P 500 right now up 26 points. That's up 0.5%. 49.79 on the index. The Dow Jones Industrial Average up 44 points. That's up 0.1%. NASDAQ 100, 0.6% higher, up 113 points. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul, you got to explain to me why they're expanding their branches. I thought we were
I don't know.
debanking.
I think it's just marketing. Like on every corner in Manhattan, what is there? A branch of a bank, a financial institution. Nobody in there because everybody's doing it on their phone. I think it's just a big billboard.
It feels like it's an expensive billboard.
It does. It seems like
Or an
very expensive.
opportunity for the bankers in person to pitch whatever services that bring in
You
lots
go to
of
a bank,
fees.
I mean, like, who's pitching? Like, nobody's
There's one or two
nobody's
people
there,
behind
like,
you. That's
you
true.
know?
Yep.
Happy Valentine's Day, guys.
Yes,
Oh, is
exactly.
that today?
It is today.
Is that today, Mr.
That's why you have red on.
I don't choose my clothes, but yes, this is what I was assigned to
Okay.
wear today. But happy
You get
Valentine's
assigned-
Day.
who assigned?
The people.
People?
People
have
assign
That's
the
somebody's
clothes.
job.
People.
That's a
Somebody
job.
has a job to assign.
John,
the
who's
women
assigned
clothes.
for your wardrobe?
Let's
John
not go
Tucker
there.
assigns his own
Let's not go
Exactly.
there.
Whatever's in
Whatever
it.
clothes happen to be lying on a pile.
Or the ones from yesterday that
Right.
he's allowed to sleep
I
in
know.
because he slept overnight
That's
at
how
the
we,
hotel.
That's how we rock in radio. That's how you do it in radio. So Alex Steele, Paul Sweeney, we're live here in our Bloomberg Interactive Broker Studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio. Nice little bounce back today. Feels like the S&P up 0.5%. Abigail Doolittle joins us here. She covers all the markets for Bloomberg. What do you make of today's rebound here, Abigail? Is this kind of a healthy response, maybe?
It looks a little weak to me, truthfully. If you put it in the context of yesterday's move down, we still have this big gap lower. It looks like a breakaway gap to the downside. Again, the sellers yesterday, the buyers yesterday, everybody caught off guard by that slightly higher CPI report. Just tells you how tightly wound everybody was to this narrative that the Fed was going to be cutting a lot and early this year. It's going to be interesting to see whether or not these gains hold or fold. I'm looking at volume. It's 24% below the 20-day average. Yields have come in a little bit, but not commensurate to the degree of reversing yesterday's basically 15 BIP backup. You know, you have this 2-year yield at 4.60, the 10-year yield at 4:30. I think that the theme ahead is the theme of yesterday, that inflation hasn't quite been stomped out, which is exactly what the case was in the 70s and the early 80s when the Fed was pretty aggressive. They didn't want to repeat that. And, quickly, I feel the need to chime in on banks, which right now I'm just trying to look on my screen to find out where my banks are. They're higher. So I, in fact, do go into the bank. I go to the Wells Fargo right over there, and it's often busy. So there's actually a lot of people who at least go to that Wells Fargo bank. There's one exception here in New York.
I don't get it. Anyway.
But you're not a cash person.
I'm not a cash person.
Okay, so you don't.
I'm not a cash person. Yes, this is true. I just take my husband's cash when I need it, but that's pretty much it. So one of my favorite technical indicators is dead cat bounce. What is it, and are we seeing it?
So I have a precious cat, Jojo, who's almost 20, so I hate this technical indicator. Yes, I've had her since she was a little baby. Wow. I don't know exactly, Alex, how you define it, but in terms of the Santa Claus rally, I know the precise definition for that. But basically the idea is that it's those people who had bought into yesterday's sell-off, were depressed by it, and then today feel psychologically correct and are buying back just a little bit. But again, so long as that gap stays closed, it is close so long as the S&P 500 is below 5016 spot 83. There is a trend line in the near term, interestingly enough, a year-to-date trend line that is holding higher. So there is a chance that that gap will close and it will turn out to not just be a 1 or 2 day wonder.
So close the gap and then there are no dead cats. But there's like a rhyme happening.
Yes,
bit, I think.
yes. And it'll be interesting to see whether or not that can happen. I'm a little bit skeptical right now. These markets are overbought. Plus, we have this massive, massive, massive bearish divergence. It's much more so on the high beta momentum indexes. But we talked about this yesterday. Stocks going higher, RSI or momentum going lower, which means that the recent highs are made on less bullish activity. Weaker hands are taking the markets up. At some point, the stronger, smarter, earlier hands are likely to take some serious profits.
I'm done here at 12. I'm out the door shortly.
Lucky you.
Thereafter. But I know you stay all day and look at the markets. How did the markets traded late in the session yesterday? Did you see it kind of bounce off some bottoms? Did you see it accelerate into the close? What did it look like?
It wasn't awful yesterday into the close. It was awful mid-afternoon where the indexes were down 2%. It accelerated. That said, it was orderly. It wasn't fearful. You did have the VIX at one point with a 17 handle, but into the close, we came off those lows. I think the S&P 500 closed down like 1.3%, 1.4%. The standout star in terms of the selling is the Russell 2000. It closed down more than 4%, the worst day since I think it was June or July of 2022. So those small caps, those tend to lead both to the upside and the downside. The weakness there, today up 1.3%, so a bit of a rebound, but below the 50-day moving average yesterday. I don't know, that's weak action.
It's interesting, though, because we were just talking like 2 days ago about the rally broadening out, including industrials, healthcare, and small caps. Yesterday tanked that idea, so it's going to be interesting to see if the small caps can fill that gap also. Rounding it out, Lyft and Uber, give us a quick update.
It's really unbelievable. So let's see how much Lyft is up right now. Last time I looked, up more than 30%, the best day ever since going, 37%, the best day since going public. Ever since 2019. So of course the most amazing story is here is like 50 or 500.
Yes,
there was that quote unquote clerical error, an extra zero in the press release that they were expecting margins to expand by 500 bips or 5% over the year. On the earnings call not so long after that they said it was 50. The stock came down from that 7% gain, but take a look at it right now, up 37%. Now they put up a great quarter. They had record annual ridership. The one thing I would point out here, there is a 14% short interest, so some of this could be a squeeze. But if the shorts get out completely, it could be something. We, of course, have Uber sharply higher as well, the best day since May of last year. That stock up on the $6 billion buyback that they announced the first time. It's kind of funny, the announcement, up 12%. They weren't to be outdone by Lyft. They announced. They put out this, good optics, good perception.
I saw that. And we're going to have Mandeep Singh in just a moment to break it down for us. Abigail Doolittle, thanks so much for joining us. Abigail Doolittle, she follows all the markets for Bloomberg, breaking it down. And I know Mandeep Singh, he's around here somewhere. He's going to join us in just a moment. But, when Lyft and Uber went public, I said kind of the same thing. Do I just buy both of them? And then, I know they had the Uber Eats thing, which Lyft doesn't, but I was like, how big can that be? But boy, even with today's 37% increase in Lyft, the stock still has a market cap, $6-7 billion worth. Uber's got multiples of that. It's just
huge.
Skyrocketed. It's such a huge divergence. So let's break down both of those numbers. We can do that with Mandeep Singh. He follows some of the technical sectors of this market.
Pretty much follows
Pretty much everything in tech,
yeah.
So he's a tech analyst for Bloomberg Intelligence. So let's start with Lyft.
Who's getting fired?
I took a Lyft home last night because why?
Hmm.
Because it was cheaper than Uber.
By how much?
By like 20%.
Really?
Yeah, and that's typical. One or the other. Not I just arbitraged the two. Matt Miller does not do that. I arbitraged the two. I thought everybody did that. So anyway, what happened to Lyft with their earnings last night?
Well, last night was bizarre because, you don't often see that in press releases.
Never. Somebody better lose a job there, as Alex would say.
But, at the end of the day, it was, I think, just a mistake that happened. It wasn't intentional in any way. And the stock move was pronounced because of, the short interest and the fact that obviously people were not very optimistic going into the print. And look, I think in the case of Lyft, not much has changed in terms of execution. They're still kind of a distant number two. And you talked about taking a Lyft, but there are certain zip codes where they are able to meet the ETAs that Uber has, but in other zip codes, they have no supply. So even if you want to take a Lyft, there is no availability.
All right, but my dude last night, like most markets I go to, he's got an Uber sticker and he's got a Lyft sticker, and he's got both apps open.
Wait, really?
And they all drive for each other.
Yeah, there is a huge amount of overlap.
And so literally, it's just
apparently.
It's just here's my reading of it. And you're the expert. It's just Uber algorithm, Lyft algorithm. They're different. They're going to give you different prices and things like that, but. It was 20% difference.
But
anyway.
From a driver perspective, what Lyft is doing is they are paying out more to lure drivers.
Okay.
So if it was a $10 ride, the driver is getting $7 or $8 from Lyft, whereas from Uber, they're getting $6. It's just an example.
Yes.
So that's where, the take rate matters, what these companies keep versus what the driver is getting. And that's the, I think, tactic Lyft is using to really pay more to the driver to bring on more supply.
So then how does that then play out? So at some point they get enough supply that then they can sort of make more money per ride and increase the shares. When does that moment happen?
I mean, scale is the only moat you can have in this business, scale and operating efficiency. And so what Uber has done is, obviously they have the scale. They are 6 times bigger than Lyft in just the mobility segment. And think of the gross margin. The reason why this is a 60% gross margin business is because insurance costs is pretty high for ride sharing. So how do you bring down insurance costs? Through scale. And that's what Uber has because it does, 6 times more rides than Lyft. And in the case of Lyft, if they don't maintain the supply, then they're just going to keep losing share, which is what was happening. So they have to compete on price. The only way they can maintain their share is if they offer a lower price, as they did with Paul last night. So that's the tactic, and I don't think it's going to be.
Is that a long-term model too?
Yeah.
Well, so think of what happened with food delivery. There were so many players. Now you are down to 2 or 3, remaining. It's Uber,
Which,
DoorDash.
by the way, I still will not pay for my youngest in college.
I have a hard time paying for it. I'm not going to pay $10.
We've established that firmly.
I support this.
Yeah.
So there will be consolidation, but if Uber is announcing a $7 billion buyback, they're not buying Instacart now. So that's nor they are buying Lyft.
Okay, talk about that that buyback.
Yeah.
What does that tell us? Like, when you buy back stock, isn't that because you're no longer a growth company? Like, is that the thing?
Yes, I think there is that element. And also they're going to be prudent in terms of returning cash to the shareholders. So remember, they acquired the freight business. That is a big drag on profitability. Uber didn't build freight business organically. They bought a company. That didn't work out well. They bought Postmates for food delivery. That didn't work out well. So their track record with acquisitions isn't great. And so now they are saying we are going to generate about $7 to $8 billion in free cash flow. Well, guess what? We are using $7 billion out of that for buying back our stock. I mean, obviously it's going to be over a period of time, not in the next 12 months. But I think that's good, sound capital allocation strategy. And look, this company is generating, the mobility side is very healthy. they've got mid 20% EBITDA margins. Compare that to Lyft, which what got people excited is they could get to 20% EBITDA margins. Well, not so fast. I guess that was a typo.
So
yeah,
I say yeah. All right, how about the Uber Eats business? Again, I don't support this. I mean, I know it's a great, people love it, but not on my credit card. So talk to us about the Eats business.
This is just to drive frequency.
Okay.
Just so that Paul has more transactions with
This is just
Uber.
advertising then, basically.
Exactly. And the only profit they're going to generate right now is through advertising. So the good thing working out for Uber is they have a memberships business. So that's your recurring subscription. You're going to buy an Uber membership that works for both mobility and delivery. And also they're going to show ads. So ads is $1 billion run rate business now, primarily driven by delivery, and it's almost 90% gross margin. Yeah. So that's what's going to drive the delivery profitability. But on a transaction basis, this is zero.
So this is sort of like Amazon Prime Video. Like it's just basically sell more subscriptions of Amazon Prime, up the price a little bit, and then you get more viewers who are just into it and they buy more stuff on Amazon. It's kind of the same
bundling
idea.
is the way. So they, like Uber talked about this concept of being a super app almost 3-4 years ago. And they have been working towards it. Now they have integrated taxi. Remember when Uber came to the scene? They were supposed to, or they actually disrupted taxis.
Yep.
Now they have onboarded taxis on the platform to boost supply. And taxis is about 5% of their business. So clearly, you come a full circle where you have integrated taxis, and their thing is, we'll bring everything related to transportation on one app. And you can find any and everything you need.
This guy, Dara Khosrowshahi, I mean, he's done an amazing job turning that company around.
Minus the acquisitions.
Minus the acquisitions.
So they're just bad at buying stuff.
And that's what he did at Expedia. Expedia was built around acquisitions. There, I think acquisitions worked out probably better than they did in Uber. But clearly acquisitions wasn't.
And so one of the potential acquisitions that was out there was Instacart to ramp up their Uber Eats. But you're now saying the stock buyback signals that unlikely to do that.
That's completely out of question. I mean, the question is, can DoorDash buy something given, like, the reason why Lyft's stock moved this much is because the valuation is like 1 times EV to sales.
Yep.
Compare that to DoorDash 5 times EV to sales or Airbnb 10 times EV to sales. So clearly, a lot of the growth prospects are reflected in the Lyft's valuation.
Yeah, Airbnb, we'll do that next time. I'm just, I don't know, I'm just not comfortable with that concept. But I know a ton of people are around the world and they love it, so we'll get to that next time.
Staying or renting out your house or staying in someone else's house?
Both.
Okay.
I don't know, but I don't know.
It's really not that weird.
Yeah, coming into somebody else's house.
No, because it's more like an investment property a lot of the time.
All right, Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence. We appreciate you stopping by, giving us the latest on Uber and Lyft. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg News. Remember this Bloomberg Business Flash? We're being brought to you by IBKR. Investment advisors switch to Interactive Brokers for lowest cost global trading and turnkey custody solutions. No ticket charges and no conflicts of your interests at ibkr.com/RIA. Well, stocks delivering a partial rebound after yesterday's slide that was triggered by the reset in Fed rate expectations. Federal Reserve Bank of Chicago President Austin Goolsbee says higher inflation data for a few months would still be consistent with a path back to the central bank's goal of 2%. Traders are now only fully pricing in 3 Fed rate cuts for this year. S&P 500, 34 points higher. That's up 0.7%. We're at 49.87 on the index. The Dow Jones Industrial Average up 117 points. That's up 0.3%. The Nasdaq 100, 153 points higher. That's up about 0.9%. After yesterday's surge in yields, 2-year yield is down this morning 5 basis points. That's at 4.60. The 10-year 2 basis points lower, and that's at 4.28. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Paul and Alex.
Thank you. Thank you so much, John Tucker. Happy Valentine's Day again to everybody. This is Bloomberg Intelligence. We cover all the industries, all the companies you need to know with our amazing lineup of Bloomberg Intelligence guests. 2,000 companies in 130 industries. I want to dig a little deeper into the small cap world because the Russell 2000 is up 1.6%. Now, the narrative, if you just rewind to Monday, was that we were broadening out this rally in the S&P, that it wasn't just big tech. We were finally seeing small caps get a little bit of a bid. Well, let's talk to Brian Smoluk. He's principal and portfolio manager of the Hood River Small Cap Growth Fund. He joins us from Palm Beach, Florida. Much to Paul's pain as he looks at the palm trees in the background. Hey, Brian.
Killing me.
Do you buy small caps here? Like, are they actually going to finally make a good comeback?
I think so. The CPI print yesterday clearly didn't help things near term, given the Fed was a little bit too aggressive in December when they talked about aggressive cuts this year. But I think once the CPI does settle down to a level that people are comfortable with where the Fed's going to cut, it's a matter of when, not if, then small caps will outperform. You see that when people want to put on risk. Small cap, particularly small cap growth, tends to put on a really big move. And then in Q4 last year, when that happened, the space really ripped. And it's been a fairly protracted period of big underperformance for the last several years. So the setup is good given valuations, earnings revisions are trending positive. Spreads, which are a great leading indicator for small cap stocks, have tightened significantly to just a little over 100 basis points. So the odds are highly in the space's favor for it to outperform over the next 12 months.
Hey, Brian, am I going to get a valuation break if I go down into smaller mid-cap territory relative to the S&P 500?
Yeah, so if you look at small cap growth versus the S&P, it usually trades at a premium. Right now, it's trading around 18 times 2025 earnings versus the S&P at 20 times. So you do get a discount there, and that's part of what I was saying why the setup is good, because you get a relative valuation break. Usually, the growth is faster in small cap names. I wouldn't expect this upcoming cycle to be any different. So that's why you'll get probably some multiple expansion and positive earnings revisions, which should lead to outperformance over the next 12 months.
Hey, Brian, would you have made a different argument 6 months ago? Because small caps did have a moment last year, and that moment was short-lived. Is the argument different now?
I would say it's honestly pretty similar. We're bottoms-up stock pickers trying to find companies with a dislocation of fundamentals versus valuation. It's been a constructive setup, and 6 months ago, it actually was good when you're looking at Q4, and small cap ended up putting a move on to being up around 19% for the year last year. So it was solid, but it has been a waiting game for small cap, and you need rates to cooperate with spreads for the sector to work.
Fortress Aviation, FTAI is the ticker. What's the call there, Brian?
We like the stock. It's one of our bigger positions. It's been really huge over the last 18 months. We think there's still some significant legs left in the story for it to really work. It trades at around 20 times earnings. They have a new module repair business for engines that's growing around 100%, and we think there's upside in that area, particularly when you look at all the news in the supply chain, and airlines across the world really need to optimize how well their current engines work, given that they can't get new engines or new planes when Boeing's having all these problems. Meanwhile, the asset value on their current engines has been moving up because of the supply-demand imbalance created by the fact that new planes really can't make it out the door, and you have rising demand around the world continuing for passenger travel.
You also have Celsius, which is it's like a Red Bull energy drink, right? I know it's different, but it's the same kind of idea. You like this company? How come?
Yeah, we've owned it for a while. It's a secular market share gainer. We think in the category, it's gone from around 2% share to 10% share. We think they can reasonably get to 20% share. They have a partnership with Pepsi that's ramped up over the last 12 months. Pepsi's the largest distributor in the world, and fortuitously they left Budweiser, which obviously wasn't great with all the Bud Light issues that they were having. And we think the street's at about 40%. They could easily grow 50 this year, and the stock's just around 13% share. And as I said earlier, we think they can get to 20.
And have you ever had one of those energy drinks?
No.
I'm scared of them.
Yeah.
Celsius
I'm
is
sure
a
they're
little
great.
bit. Celsius is a little bit healthier. It's all natural ingredients. You still get the boost from caffeine. It's 200 milligrams of caffeine. So yeah, I definitely wouldn't take it before you go to bed. But it tastes better. And it's healthier than some of the other drinks out there.
Yeah, I don't know. Hey, Brian, how do you define kind of like the market cap? Like, what's a small cap? What's a mid cap for you? And what happens when they maybe grow out of those levels?
Yeah. So the last 6 months has been abnormal for the sector in that there's been a huge bifurcation. So within the Russell 2000 growth, for example, super micro is actually in the benchmark, and it's over a 30 billion market cap. So normally I would say the range is between, call it 100 million up to 6 or 7 billion, but it has expanded over time. The sweet spot really is in that $2 to $5 billion range, and those stocks tend to be a little bit more inefficient. And we don't typically sell a stock when it gets too big. It's really when we think it's efficiently priced based on the fundamentals, or we think something bad's going to happen, we'll step aside.
And it's a leading question because we're talking about you manage a small cap growth fund, but growth versus value in the Russell, is it the same kind of thing as what we see in the general market? Growth, tech, everything else, value.
Well, in small cap growth, you do have a larger percentage of software companies, semiconductor companies, biotech, and a little bit less financials, and then some of the higher growth consumers. But small cap growth and small cap value are relatively highly correlated, but in different areas. There can be big dispersions. Like in 2020, you saw growth massively outperform value, and then it completely inverted the prior year. We frankly try to be agnostic and try to find companies that are growing reasonably quickly, call it 15%, but are inefficiently priced. So we kind of thread the needle there.
There's a good article in the Bloomberg Terminal today. Florida boom cools an area where home insurance costs tripled. Hurricane Ian worsened already rising homeowners rates, and they called out like Naples, Sarasota, Cape Coral. I noticed you guys own some exposure here. HCI Group is a homeowners insurance company based in Florida. Uh-oh.
Yes.
What's that about?
Yeah, so it's been a great stock because of the dislocation in this particular geography. And what's happened is the lawyers had the upper hand, not a big surprise, for an extended period here. A lot of insurers pulled out because of that, because they were having massive losses. The state legislature came in, made it so that it was more reasonable and favorable to insurers. HCI was set up well to write new premiums profitably, as well as take over existing premiums from the state entity, which is called Citizens, which allowed them to dramatically outperform expectations, and earnings growth is significant. So it's trading at 11 times earnings. We actually think there's upside to that number. And they're just set up well because of supply demand in the area. And as you know, the area is really growing. So you have a lot of people moving here, so demand is strong.
As Paul talks about all the time.
Mhm.
You do want to move here, don't you?
No,
He doesn't.
That's a hard no.
Okay, it's a hard no, but he does get jealous of the palm trees.
Yes.
What I find interesting, though, when you talk about insurers is that, Florida is going to get hit with storm after storm, and it is a bit worse now. And I just wonder how the risk premium you got to bake into these stocks.
So weather is a big issue, obviously, during hurricane season. HCI has been here forever, and they've done a good job pricing for that risk. So you just got to assume over an extended period of time that when you take your lumps, you're going to more than make up for it based on pricing. And as you noted from that article, pricing's up huge, and there are a lot of different reasons for that. And in condos, for example, there was that condo that went down in Miami, and that jacked up premiums all over the area. And insurance companies were able to capitalize because now condos realized they just had to become conforming with state code. So to me, hurricanes are a manageable risk here. There's actually been less direct hurricane impacts on Southeast Florida than up in the Northeast where you guys are. So, but you do have a fair amount happening in the Gulf, but there's less population in Florida and the Gulf than on the Southeast side.
All right, Brian, thank you so much for joining us. As always, Brian Smolik, he's a principal and portfolio manager of the Hood River Small Cap Growth Fund, not in Bend, Oregon, but in Palm Beach Gardens, Florida. So go figure there. But some good stuff on the small mid caps. They had their time in the sun there in the end of that surge last year. The question is, are there more legs going forward? With our news in New York City, here's Michael Barr.
Thank you very much, Paul, Alex, John. Democrat Tom Suozzi has won the race to succeed ousted New York Representative George Santos. Suozzi's victory over the Republican candidate, Mazi Pilip, flipped the Long Island district back to Democrats and narrows the House Republicans' already slim margin. Suozzi represented New York's 3rd district for 3 terms until last year.
Let's send a message to our friends running the Congress these days. Stop running around for Trump and start running the country.
Suozzi had 54% to Pilip's 46%. The House voted to impeach Homeland Security Secretary Alejandro Mayorkas over the Biden administration's handling of the U.S.-Mexico border. The Republican majority impeachment vote failed last week. Last night's GOP vote won by only 1 vote, with the arrival of Majority Leader Steve Scalise, who has been away for cancer care.
You've got Democrat mayors who are calling on the president to fix this problem, and yet the president ignores it. So
it now moves to the Democratic-controlled Senate, where it's predicted to fail. Defense Secretary Lloyd Austin is out of the hospital. Austin today provided opening remarks virtually for the Ukraine Defense Contact Group's get-together taking place in Brussels, Belgium.
The Kremlin keeps on betting that we will all lose interest in Ukraine and that our support will flicker and fade. But I am more determined than ever, and I know that you are as well.
Secretary Austin was discharged from Walter Reed National Military Medical Center yesterday after he was hospitalized for a bladder issue. Downtown Kansas City is turning into a sea of red for Valentine's Day as Chiefs fans prepare to celebrate their 3rd Super Bowl title in 5 seasons with a parade. The mayor says it never gets old. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg News. And with this Bloomberg Business Flash, S&P 500 hovering right around 49.90, I should say. Treasury 10-year yields falling 2 basis points, right now at 428. Dollar fluctuating. And then you have Bitcoin climbing past $51,000 in a broad cryptocurrency rally. Deepak Puri at DWS, meantime, says yesterday's hotter-than-expected inflation report really shouldn't change things all that much.
The disinflation traction is there with us. I don't think that's going to go away anytime soon. What yesterday's number has told us that we shouldn't count on it. It's not going to be a linear single-line decline on inflation front.
And Uber is going to buy back as much as $7 billion in shares to return capital to shareholders after reporting a first full year of operating profit. Lyft, they issued a massive correction today to its outlook for its earnings margins. And Airbnb, ending 2023 stronger than analysts had expected, also suggests that demand in the current quarter is not going to be as robust. Right now, the S&P 500, 29 points higher. That's up 0.6% at 4982. The Dow Jones Industrial Average, 90 points higher. The Nasdaq 100 up 130 points. That's a rise of about 0.75%. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that's your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate that. Alex Steele and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, and also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. The big take story today, I've been waiting for the good folks at Bloomberg News to write the definitive article on commercial real estate, because, man, I think it's going to be brutal out there when we start seeing some of these big properties trade and where they're going to trade relative to pre-pandemic. And the numbers aren't pretty. And Natalie Wong and Patrick Clark from Bloomberg News, they wrote the big take story today. Go check it out on Bloomberg Terminal or go to bloomberg.com/bigtake. And they've got some big numbers, lots of data in there, talking to some banks, talking to some real estate developers. Pat Clark joins us here. He's a real estate reporter for Bloomberg News. He's in our New York studio. Pat, if I take a look at an average, decent office property in a New York or Chicago or San Francisco or LA, and I sell it today, what discount am I going to take to my, I don't know, pre-pandemic level, or maybe what I valued it when I took the mortgage out, for example?
I think New York City, which is better than other markets, right?
You are?
Oh, yeah. I mean, New York City, you're looking, I think, probably 15-20% discount.
That's
on average, right? There's going to be better winners and losers in it. San Francisco, where obviously unless AI bails out the San Francisco office market, you're talking about 40% discount. Wow. So hurting.
Wow. Question. Why did it take so long to write this article? I know Paul's been waiting for it. What did you have to wait for to write it?
It takes me a while to type.
Oh, no, I don't mean that. I was like, what are you talking about? No, but just like what you had to wait for data, right?
Yeah, 100%.
And why was it so hard?
We wrote stories about this 6 months ago. We knew this was coming, right? I think if we had really been on the ball, we could have written this story in the summer of 2022 when interest rates went up. It was baked in then that values, and it's not just real estate, but it's certainly real estate, that values were going to have to come down. And, it's in nobody's interest to recognize losses, whether it's the lender or the borrower or the...
But how do they push it out? Like, how do they avoid it? What are the tools?
Right. I mean, it's just kind of garden variety, extend and pretend. Your loan may be due, but your lender may modify it because the lender doesn't want the asset. If they have it, now they're stuck trying to lease out a building that, doesn't have a lot of demand for it. So, it kind of sounds silly. It's just as easy as you owe us, $120 million, and you're like, well, I don't really have it. I don't want to give it to you. And they're like, okay, well, let's figure something out. Bank regulators gave lenders permission to do this last summer, and they basically said you should work with borrowers. It's really in nobody's interest to have a lot of assets going back, but it can't last forever.
there's lots of good data in this article, one of which is about who's coming back to work in terms of occupancies. And apparently, if you look at Asia Pacific, if you look at Europe, they're, I don't know, 70, 75% kind of back. The U.S. is just about 50%. That's a problem, right? Because if I don't need the space, if I'm not forcing my people to come back, and this is going to be I guess it seems like a more structural issue in the U.S. than maybe other parts of the world.
So this is a really big question. If it is a structural issue, if this is the same thing that happened to shopping malls, right, where all of a sudden we learned to shop online, and some malls are still good for some things, but we way overbuilt malls for the way people want to shop today. If that's the case in the office buildings, it really does become a puzzle. What do you do in central business districts that are all office buildings or virtually all office buildings?
I think about a town, this is my first experience when I was a young person traveling around, that there are a lot of cities where when the day is over, there's nothing. And it was Charlotte, North Carolina for me, with all the big bank towers. And it was hustling and bustling during the day, going to meetings, everything like that. 6, 7 o'clock, I go out of my hotel to go get something to eat. Nobody there. And that's like a lot of cities around the country. And if they're going to have lower occupancies during the day, I think San Francisco, for example, those are some big structural issues. I'm not sure what the solution is if I'm a real estate developer or if I'm a bank holding that mortgage.
Yeah, or if you're a city government that depends on collecting tax revenue from owners of office buildings, which, you can keep sending them tax bills, but at some point they're going to say my building is worth 60% of what it was, and you're still appraising me based on unrealistic value.
So who gets burned? Who are the guys left holding the bag?
So one place to look is the regional lenders. They have greater exposure to commercial real estate. I think something like 70% of bank exposure to commercial real estate is at smaller lenders. Those are the places that don't have other revenue streams that they can use to build reserves against the losses as they come in. So, that's one place to look. Certainly, I mean, I think all of us, though. I mean, to Paul's point, if a downtown becomes a ghost area, right? It's really not good for anyone. Look, I mean, the question is, and this has been a mantra for a while, is like last year we were hearing survive till 25, right? There is some sense that interest rates are going to come down. Eventually, things will improve in terms of your ability to refinance. So we'll see who skates through.
Well, also, isn't everyone saying like get your butts back in the office now?
Are they? I don't know.
They are.
I mean, they are here. We're 4 days here, right?
4 days. I think we're 4, but I feel like tech companies are starting to push that too, because a big issue with this is tech. We have so many tech companies you can work remotely.
I would think so. Now, I mean, and what I noticed in your reporting about some of these office building owners, these are not like some schlubby local people. This is like Blackstone. So you got to hear in your article, Blackstone, an office building, I guess it's 1740 Broadway, right smack in Midtown. They're looking to, I guess, market some of the debt. They're at a 50% discount. So that reflects kind of what you're saying, I guess.
And if places like Blackstone are going to be, they're going to be strategic and opportunistic about it, and they're going to be walking away from buildings here and then looking to buy somebody else's problem there. But it does make you think, if this is a problem for the Blackstones and the PIMCOs of the world, what about the guy you've never heard of who owns a small office building in Charlotte?
Yeah, there's also an article on the terminal talking about Blackstone in particular. They're aborting their Canary Wharf sale. To that point, they were setting it up to sell to an Asian investor late last year, but that deal has now collapsed, according to people familiar with the matter. Yeah, that's the area that houses the new home of BP's oil trading unit. So they're definitely feeling it too, but clearly they have more muscle to manage.
Okay, time for real estate trivia.
I know that.
Oh, here we go.
It's not Fornado, it's Vornado. What did they used to sell? Vornado Realty Trust.
Fans.
The Vornado Tornado. 2 guys. And when 2 guys went belly up, they took over all their properties.
Really?
Yes.
I think he just spends hours up in the dark portions of the internet finding silly trivia.
I just want to know what the correlation. So we're talking. Paul says the word, and you're like, Vornado.
Oh, that brings something.
Yeah. Well, Pat knew, right?
3 o'clock in the morning. I read this on some YouTube thing, or I don't know where to get. Pat Clark, thanks so much for joining us.
Knew that.
Real estate reporter for Bloomberg News. Again, check out Pat's article here with Natalie Wong here. It's the Big Take story. You can find it on the Bloomberg terminal. Bloomberg.com/big take. Lots of data, gives you a sense of kind of where we are in that part of the market. This is Bloomberg.
Your company news headlines on Bloomberg Radio.
And I'm John Tucker in the newsroom. Look at some of the companies we're following this morning. X, the social media platform owned by Elon Musk, potentially is violating U.S. sanctions by accepting payments for subscription accounts from terrorist organizations and other groups barred from doing business in the country. This according to a report by the Tech Transparency Project. This is a nonprofit focused on accountability for large tech companies. Well, they say that X, formerly known as Twitter, has taken payments from accounts that include Hezbollah leaders, Houthi groups, and state-run media outlets in Iran and Russia. These subscriptions, which cost $8 a month, offer users a blue check mark, once limited to verify users like celebrities, and better promotion by X's algorithm, among other perks. PNC Financial Services talked about this a little earlier, says it's going to spend about $1 billion to open new branches and renovate existing ones through 2028. The plans call for 100 new branches in Austin, Dallas, Houston, San Antonio, as well as Denver, Miami, and other locations. The Pittsburgh-based bank also said it's going to renovate more than 1,200 of its roughly 2,300 locations across the United States. While online banking and ATMs have reduced the need for in-person branch visits, banking executives say they see the value of having a strong brick-and-mortar presence. And each of the past 2 years, nearly half of U.S. spending on Valentine's Day, flowers, candy, and cards occurred between February 11th and February 14th. This according to Numerator, the market research company. Walmart, for example, they sell 40 million red roses for the holiday. They say around 75% of the sales occur on the 13th and the 14th. That's company news.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good late morning. I'm Alex Steele here with
But you
Paul
want to get
Sweeney
your
and John Tucker.
flowers fresh, so you buy them at the last. That's my excuse.
I mean, yeah. Also, like, who cares? Like, it's Valentine's Day is a constructed holiday by Walmart. So who cares?
But it's not the number one gift, by the way. Is not flowers. It's candy.
Either way, don't eat it. Don't care.
Nice.
I also think I missed a romantic.
Are
gene
you being
somewhere,
like
but-
a simple girl, or like
She missed a romantic gene somewhere.
Yeah, I just feel like Hallmark's telling me to go do something fancy. Come on now. I don't know. Anyway, I'm Alex Steele, Paul Sweeney, John Tucker. This is Bloomberg Intelligence Radio. Let's get over now to Michael Barr for world and national news.
You need the number to my house. Anyway, Defense Secretary Lloyd Austin provided opening remarks virtually for the Ukraine Defense Contact Group's get-together taking place in Brussels, Belgium. Austin was discharged from Walter Reed National Military Medical Center yesterday after he was hospitalized for a bladder issue.
I planned to be in person with you today in Brussels, but I had to return to the hospital for non-surgical procedures. I'm in good condition, and my cancer prognosis remains excellent. And I'm really grateful for all the well wishes.
Secretary Austin went on to say the Kremlin keeps on betting that we will all lose interest in Ukraine and that our support will flicker and fade, but we're more determined than ever. The race to replace ex-Congressman George Santos has resulted in House Republicans losing a seat in what's already a razor-thin majority. Democrat Tom Suozzi beat Republican Mazi Pilip in New York's 3rd Congressional District's special election, 54% to 46%. Suozzi held the seat for 3 terms before losing to Santos in 2022. In his victory speech last night in Woodbury, Suozzi thanked supporters for sending him back to Congress.
Despite the dirty tricks, despite the vaunted Nassau County Republican machine, we won.
Voters endured a snowstorm to cast ballots. The parade route for the back-to-back Super Bowl champions Kansas City Chiefs is lined with Chiefs Kingdom. Fans have been braving the morning cold for a chance to catch a glimpse of the Lombardi Trophy. Head coach Andy Reid, quarterback Patrick Mahomes, tight end Travis Kelce, and possibly his better half, Taylor Swift.
That was amazing. McCall Holman was awesome. Andy Reid, perfect play ran. We're running a dynasty out here, guys.
The parade begins at noon Eastern Time. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg.
All right, Michael Barr.
Alex.
Thank you so much. Okay, so we can talk about flowers and Valentine's Day, or we can talk about SATs.
SATs.
You want to do SAT? He wants to do
I'm
SATs.
done.
You don't care.
No, I don't care anymore.
Yeah, fair enough.
Yep.
So it's in my life. So apparently, Yale University is now considering reinstating standardized testing, joining Ivy League peer Dartmouth College in a policy shift that reflects a broad reevaluation within higher education admissions. Now, some and selective colleges did ditch the exam like SATs and ACTs early in the pandemic because you had test centers that were closed, but now they're re-upping that decision.
So
blah, blah, blah.
4 kids, I have 4 kids, 3
Yeah.
of which had to go through all the testing stuff and all the, the usual anxiety associated with all that and blah, blah, blah. And is it reflective? My last one, who is a freshman in college now, did not. And I'll tell you, it was so much better for the student and for the parents, maybe even more so for the parents.
What's the criteria now based on if you're
Like GPA gets a higher weighting.
All right.
And standardized test takes a lower
standardized. They're standardized.
They're standardized.
GPAs, different high schools. You don't know what kind of grading
I know, but
standard.
do standardized tests tell you anything except the person can take the test well? No.
That's
right?
the
I mean,
question.
That's the whole point. Like, then you're just learning how to fill in the holes.
The Dartmouth Dean of Admissions is saying that, here's the Dartmouth Dean of Admissions.
You don't want testing?
The
You don't want
SAT
flowers?
or the ACT is the single best predictor of a student's academics performance at Yale. That's the Yale admissions person. Challenging a widely held belief that top high school grade point average is often a better indicator of future economic outcomes. So is it GPA or is it standardized test is a better predictor? There is a split there. And it was just easy during the pandemic saying, well, they shut down all the testing centers anyway, so What's his bail on it?
Yeah, no flowers, no SATs. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, coming up, we're going to check in with Lyft CEO David Risher. He speaks with Bloomberg Technology co-host Ed Ludlow and Caroline Hyde. We'll bring that to you in just a moment. Because, Alex, Lyft had some numbers last night. Street liked it. Stock's up 33%, 52-week high. Little misunderstanding as to how much margins are going to improve this year. Is it 50 basis points or 500 basis points? A little bit of a typo there, but it's 50 basis points, and that's still good enough to push the stock higher. Stock's up 33%.
So, okay, maybe you were disappointed with the re-rate on margins. However, it was able to maintain some of its boost. We were talking with Mandeep Singh, though, about how Lyft has to compete with Uber, and to do that, they have to take a margin hit. So margin improvement's good, but it's a dicey area. They want to make up in volume.
It is, and it's we've seen that dichotomy, or the different diverging paths that the stocks of Uber and Lyft have taken. Uber's really taken off and increased its market cap. Lyft to a much lesser degree, but maybe this is the beginning of a little bit of a turnaround. We'll hear from them coming up. I just take whoever offers me the lowest price. That's how you do it. I arbitrage the two. So
I guess exactly what Lyft is trying to do. You are feeding into this marketing plan.
Exactly right. Right now, Bloomberg Technology co-host Ed Ludlow and Caroline Hyde, they sit down with Lyft CEO David Risher to talk about the future of Lyft. Let's bring that conversation to you right now.
Welcome to our TV and radio audiences worldwide. Joining us now on the company's fourth quarter earnings is Lyft CEO David Risher. And David, a clerical error.
Yeah.
What happened?
Well, look, first of all, it's on me. There are a lot of eyes on this press release, but at the end of the day, my bad. But look, I don't want it to take anything away from the butt-kicking performance that the business did, thanks to all of our employees and thanks to millions of drivers. I mean, look, we had our financially strongest quarter we've ever had, and I'm super excited about it.
To be clear, this was simply a mistake?
Yeah.
Human error.
Human error.
The stock rose as much as 67% in after hours. As Caroline pointed out, it's significantly higher this morning. Yeah. And we can talk about the performance in the quarter gone and the performance in the current period. This may sound bizarre to you, but I think it's a real question. Did you guys use AI to write that press release? Seriously? Or is this as simple as you are calling it a clerical error?
No, it was a clerical error. Yeah. No, we're not at the point where press releases can be written by AI, at least not financial press releases. No way.
I hate to ask it because real people's jobs are now on the line, I'm sure, David. And I want to ask, is the CFO's role safe? Is this going to have repercussions from across your membership and employee base?
The CFO's role is 100% safe. 100% safe. Look, she and the team are taking this incredibly seriously. And you have to understand, I mean, we go through hours and hours of checking and double checking before something like this goes. It's an unacceptable error. Again, ultimately, it's on me. I'm the CEO. Buck stops with me. But the team is taking it super seriously.
And I know that you want to be talking ultimately about how you're seeing growth in the business. And I'm sure that that's something that, in a way, the salt in the wound is even greater because you had a great story to tell and it got marred by this particular error. But people are going back and saying they have never seen anything like this in history, David. What would you do differently in the next earnings? How can you make sure that investors feel confident in the statements that you put out to them in the foreseeable future?
Yeah, I mean, look, I would look at our record and look at the growth, look at the fundamentals of the financials. And to be very clear, it was a bad error, but it was 1-0 in a press release and, a lot of other pages. And of course, we corrected it within seconds of finding it. So I think, like with any mistake, I think it's not so much about the mistake itself. It's also about how you correct for it. And we've corrected for it, obviously, in the moment, putting out new materials, but also doing a really deep process dive, including having our own internal audit team, a separate team, look and figure out how we can make sure we never make a mistake like this again.
Okay, if you're listening on Bloomberg Television and radio worldwide, we're joined by the CEO of Lyft, David Risher. And I go back to the current stock performance. You are still up 32% in the session.
Yeah.
And there are so many stories within that, but I zero in on the gross booking outlook. Strong.
Yeah.
What is the story there? For me, I'm trying to make sense of the gig economy more broadly on both the demand and supply side. But if you look at the consumer, you look at corporate spending, you guys are adding to this narrative that things are quite rosy out there.
Yeah.
And when does that stop? How long does it last?
Well, look, I don't know when it stops. That's a tricky thing to predict. But here's what I can tell you. We've had now 4 quarters of growth, increasing growth. And we had our biggest growth year last year of our company's history. And by the way, we're talking about billions of dollars. By the way, billions of dollars that end up going in drivers' pockets. So you can see this is a really important part of the economy because it's a really important part of people's lives. When people take the 700 million trips they took last year on Lyft, they're going to see their parents. They're going to a Taylor Swift concert. They're going to work every day. They're coming home from work. They're going to see their doctor. This is an important part of people's lives. And then when drivers are driving, they're earning to save for a house. They're earning to save for tuition. They're earning because maybe they lost a W-2 job and they're 3 weeks away from picking up a new job and they need something to bridge them. So it doesn't surprise me that the gig economy is becoming an increasingly essential part of people's lives and people's economic lives.
Your bigger competitor, Uber, succeeded by adding new products to the app, diversifying even within ride-hailing.
Yeah.
And it proved that its algorithm is working in matching riders with efficient routes and drivers. Do you feel that you're going to be competitive in those domains?
I do. Look, our focus is a huge strength. We are 100% focused on rideshare. You know, just yesterday we launched Women Plus Connect that allows a woman rider to pick a woman driver all across the United States, 270 markets. It's been a huge success over the first 6 months when we've been kind of trialing it. We launched a new driver standard that allows drivers to get a guarantee that they'll never earn less than 70% of what rider pays them after some fees. So, you know, this is the sort of innovation that we can do because we're focused on rideshare. And look, I expect Uber to do pretty well. I think we'll do pretty well too. I think this is a really strong sector.
I'm going to go back to the drivers, David, because what's interesting on this day is there is strike action. There is, on Valentine's Day, whether you're going to be flying to Miami, whether you're going to be flying to Chicago, there might well be issues trying to get an Uber or indeed a Lyft, and also in the UK as well. I'm interested as to what's happening when you are offering 70% guarantee. Why still do they want to demand more, even if you say, look, I'm giving you flexibility?
Yeah, I mean, first, on the strike itself, Carolyn, it's been in the works for weeks. You know, so it predates the announcement of this new 70% guarantee. If you look at what the drivers are asking for, and I think these are reasonable things to bring up, they want more transparency on their pay. We've given it to them. We give them a very, very clear weekly breakdown that says this is how much riders paid you, this is how much we took, this is how much you get. They've asked for a guarantee, right, so that they don't, you know, so that there's a floor to their earnings. We've given them that too. They've asked for better visibility into deactivations. You know, if you as a rider raise a complaint about a driver, we have a whole process we go through. And drivers, of course, don't want to be off the platform, particularly if they think it was an unfair accusation. And now we cover something like 70% of those in less than 24 hours, and there's a new one-click button that allows drivers to sort of appeal the deactivation. So what we're doing is we're focused on drivers because we're obsessed over customers. That's kind of our thing. And by doing that, we think we can address a lot of their issues that they're raising.
JP Morgan actually completely in line with some of the words that you use there. The customer obsession is something they point out. The marketplace health is something they see to continuing to improve on supply tailwinds. So really, drivers are not your issue at the moment compared to JP Morgan. Another analyst over at Nathanson, though, saying ultimately you're at the mercy of Uber when it comes to pricing power and take rates. Do you feel that way, that you're at the mercy of Uber in some way?
No. I mean, it's a competitive marketplace. So I think, you know, to a certain extent, they're at our mercy like we're at theirs, right? We can't do things that are completely different and expect to have, you know, kind of reasonable results. But at the same time, you know, for example, let's again look at this driver earnings guarantee. That's a commitment we've made. It's a leadership move we've made. You know, we'll see whether Uber follows or not, but that's an area where I would say they're going to want to look pretty closely at what we're doing and decide whether they want to follow us. But I think, to be honest, I think this is a healthy marketplace. It's got two good players in it, Uber and Lyft, and we're both doing a good job. I like our strategy better because I think we're more focused on riders and drivers, and I think that's a real strength. But, you know, they're doing a diversification thing. We'll see if that works for them.
for our Bloomberg television and radio audience, we're speaking with Lyft CEO David Risher. And David, as you know, we always go to our audience and ask, what would you want to know from David Risher? And it's the same question every time. Is Lyft an acquisition target? And many people put forward hypotheses about the type of business, maybe an automaker, maybe another convenience app. But where's your head at with that? You called your earnings performance butt-kicking.
Yeah.
But there are still free cash flow questions. There are still scale questions with Lyft.
Yeah, well, let me talk about those and then get to the core of the question. Look, we were free cash flow positive for the second time in our company's history this quarter, and we've committed to investors we'll be free cash flow positive for the year of 2024. So, and we have $1.7 billion in the bank. So from a cash perspective, we're in pretty good shape. From a demand perspective, we're in good shape. Highest demand ever. From a supply perspective, we're in good shape. Highest driver's hours since 2019. So, from a basic core, and then again, you think about it, 700 million rides in a year. I mean, think about a Delta Airlines that might do a couple thousand, maybe 3,000 or 4,000 takeoff and landings a day, whereas we do, let's say, 2 million a day. So our scale isn't really an issue for us. We've got pretty good scale. As to the acquisition thing, just like people ask the same question, I always give the same answer. It's like, our phone, we'll pick up the phone if someone calls because that's the deal, but it's not our focus. Our focus is customers.
All right, Lyft CEO David Risher on set here in San Francisco. Thank you so much for your time.
All right, that was Bloomberg Technology co-host Ed Ludlow and Caroline Hyde speaking with Lyft CEO David Risher, leading off some questions on how did that press release get out with such a big typo and had such a market-moving impact in aftermarket trading. And he's saying basically the buck stops here with me, although I'm sure there's a million controls that somehow didn't work. So, but I guess the message he prefers to get across is we had a good quarter, we're on the right path, all that kind of stuff. But they've got a long way to go to catch up to Uber, but I don't think that's their strategy anymore.
I mean, it can't be, right?
It can't be. I think it's kind of what he said is basically we're just going to focus on our market, U.S., our customers, and our drivers, and we're going to develop that, and we're going to be free cash flow positive before you know it, and we'll see how it likes it. The stock up 32% today, so whatever message he was trying to get across, it did. It looks like it got across in a good way. All right, let's take a break here. We'll reset here with Mr. John Tucker and a Bloomberg Business Flash.
All right, and this Business Flash being brought to you by Commonwealth, supporting more than 2,000 independent financial advisors with the solutions they need to grow a thriving business. Commonwealth, go where you grow. Visit commonwealth.com to learn more. With the major stock averages higher, but they've shed some of the earlier gains. S&P 500, 18 points higher. That's a 0.4% at 49.71. The Dow Jones Industrial Average right now, 49 points higher. That's up 0.1%. The Nasdaq 100 up 59 points, a rise of 0.3%. Two-year yield, 7 basis points lower. That's at 458. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker, and that is your Bloomberg Business Flash. Alex and Paul.
All right, John Tucker, thank you so much. We appreciate it. Alex Steele, Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. One of the reasons we like checking in on our Bloomberg Intelligence Research because it's global. And we have analysts in Europe, analysts in Asia, and analysts in North America. One of the analysts we're going to check in today is Jillian Davis. She covers autos and the auto parts suppliers. She's based in London. She covers the European suppliers. And one of the companies here is a big company, Continental. It's based in Germany. It's a $15 billion market cap company. The stock's kind of flat year to date, up 15% over a trailing 12-month basis. But they're cutting some jobs there. And I'm wondering, is this an auto industry? Is this a Germany issue? What's going on here?
So has to be auto.
It has to be auto. Jillian Davis, she joins us from London. Jillian, talk to us about Continental. Just give us a sense of what Continental does. It's truly a global company. They do business all over the world. And then why are they cutting jobs here?
Yeah, thank you